you have to approach to the bank. Bank is easily ready to give the loan to you? No, it is not. Bank has give only for loan for your historical background, all these things. So at the time you need some new financial institution to providing a finance for startup on innovative business ideas. So the finance may be required for the startup development or expansion or purchase of a companies. In India, these venture capital finance is very helpful for the entrepreneur to develop his new ideas, that is innovator, introduction new ideas, new methods and new techniques in the field of business operational activities. So this type of financial institution is very useful for the entrepreneurs for getting to start up the new enterprises in its new ideas, introduction of new ideas, new product, all these things. So venture capital means the finance may be required for the startup development or expansion or purchase of the companies, like new companies or ventures that have a limited operating history. You are not a leading businessman, you are not a famous businessman. Now only you will enter into the field of the business. So automatically banks gave some guarantees, all these things. But in these banks is give providing loan only for your innovative ideas, methods and technology. If your project is viable, these venture capital institutions are ready to give loan to you only only for the basis of the viability of the project. These financial institution is underwent your feasibility studies for your project appraisal using number of techniques are using, maybe new techniques, old techniques, methods of, and maybe you know very well that in the financial management there is number of techniques, is the older techniques and the new techniques, payback period, internal rate of return, net present value. So once the feasibility study is over, the bank is ready to give loan to start up the business. So new companies or ventures that have a limited operating history and hence may find it difficult to raise funds through an equity or debt offering. In such scenario, venture capital investor is a private equity investor play a vital role in investing in unfinanced area. These are new areas or new product or new methods or new technology. Its main aim for venture capital institution is to promote new ventures in the field of maybe a technological or biochemical or anything, which field you have. But the motto is to promote the new ventures. A simple explain about the venture capital is a private equity investors that provide capital to companies with high potential in exchange for a equity stake. A simple meaning about venture capital. Venture capital is means of equity financing. It's simple like an ownership financing for rapidly growing private companies. The venture capital firm invests funds on a professional basis, is focused on limited sector specialization. Maybe in area there is a need for development. That area you have the project. You are ready to these venture capital financiers are ready to give the like IT, biotechnology, infrastructure, health, or for example, you have to find out a new medicine for any diseases or for waste management or anything, maybe bio. So you have an ideas, you need fund. That fund is provided by the venture capital after screening all the potential things, financial nature, human nature, marketing viabilities, economical situations, all these things is considered by these financial institutions, after that providing loan to you. The venture capital investment help for the growth of innovative entrepreneurship. The main focus for venture capital is to promote healthy entrepreneurship, development of the entrepreneurship in India. So the venture capital is otherwise called as maybe a risky capital. This is a new business, maybe the risk is very high. A famous definition is given by the publication of Venture Economics defines venture capital is as providing seed, startup and first stage financing and also funding the expansion of companies that have already demonstrated their business potential but do not yet have access to the public security market or credit oriented institution funding sources. You have planned to start a business, but it is not easy to enter to the stock market for listing your shares. So you are only at the beginning stage. No one accept your shares. So at the time you need fund for development of your business, that is startup, that is for simple like a seed capital. Venture capital is otherwise called the seed capital, that is to start up the business. Start up the business is need for land, labor, capital, and organization. In terms of economics point of view, how to start the business, you need land, labor, capital, and organization. In case management's point of view, you need 5 M's: machine, material, methods, money, and you method money and methods you have used. So these sort of funds you need for start up the business. So venture capital fund is mainly need to start up the business. That is the first stage financing. So you need for the initial investment to start up the business. The main characteristics of venture capital is purely focus on long time horizon. Long time means if you have started the business, it is not the focus on your vision is on a short duration. It is purely focus on a minimum a period of 15 to 20 years. As per the venture capital has follows some norms is recommended by Narsiman committee. There is the period it refers to. It's not is to start the business for a period of 5 years or not there is more than 15 to 20 years, there is a possibility for existence of your business. So that is the main focus on your business is long time. It is not on short term or medium term. It's purely focus on long time. And a major problem faced by the entrepreneurs today is liquidity, that is current asset and current liability. It's very very difficult for day-to-day operational activities of the business. So the need for the working capital for the development of the business. So lack of liquidity is faced by the at the same time most of the business firm is suffer for liquidity decision. There is a confusing about the profitability and liquidity. So there is a need for working capital requirement. So these venture capital financing institutions providing the requirement of working capital to meet the current asset and current liability management. Especially these funds is very very useful for inventories management based on the level of you have maintained the stock levels, and your cash position is needs, and the receivable management, payable management, all these things you need the requirement of the working capital. So these financial institutions providing their working capital needs of the requirements of the working capital. At the same time, this is a very very high risk. You are a new business, you are a new methods introduced, you are start up the new business or new ideas, you are the innovator, but it is having the heavy risk. If the people or public are not accepted your product, automatically you suffer a huge losses. So there is a high risk, but at the same time, if there is a need to the society, for example, you are introducing a new product, that product is very needed to the society, definitely the product will reach the public, and reach the consumers, it will get benefited. But at the same time, the reverse is also there. So whenever there is a risk, there is a return. And the next character is equity participation. Working capital institutions providing equity capital to the businessman. Maybe it's simple like a ownership position is also in hands of the working capital institution. Sometimes it's also participated in management for making decision. Working capital financial institution representative or advisors giving advice to the entrepreneurs for making his business in successful way. So this is a main characteristics for venture capitals: long time horizon, lack of liquidity, high risk, and equity participation in management. Next one is methods of venture financing. The first and foremost method is equity contributions to the business. That is the equity funds provided. That is seed capital. Is otherwise called as risk capital provided to the businessman or entrepreneurs to start up the business. Not only for start up the business, and also the fund is provided for running the business. That is working capital. Sometimes these venture capital institutions providing conditional loan. That is, a conditional loan means it's based on some certain percentage of interest for a period of certain duration. After the period, after the duration is over, for example, for 5 crores, 10 lakhs given to the businessman for a period of 5 years. Within the 5 years, the venture capital receive only interest on its amount contributed to the business condition. After the period of 5 years, what is the duty of the business? Repay the repay the loan amount. So the conditional loan. And sometimes participating in debenture, secured loan is also provided. Debenture means secured loan is also provided to the entrepreneurs or entrepreneurs or venturers for start up the business. And quasi equity, both equity and debt financing are provided. First one is equity financing provided to the venture financing. Second one is debt, that is loan. Third one participating in debentures, and finally both equity and debt financing provided to the venture financing to the businessman or entrepreneurs. Next one is stages of financing. Now, examinations point of view, this is an important question for stages of financing. What is the first stage? Is seed money, that is low level financing needed to prove a new ideas. You have an idea to start for example a new product, but how to develop your idea, that is an idea generation stage. That time you require some funds, that is the physical form. Your ideas is converted into the physical form, that is low level financing needed to prove a new ideas. For example, not more than 5% of your the initial start of the business amount, that is the seed money for idea generation. And you have to convert your it's a full-fledged form, that is your product is converted into a finished form, that is a low level finance needed to prove a new ideas. The second stage is the startup stage, that is early stage firm that need funding for expenses associated with marketing and also product development. In this stage is the your product is coming in the form of finished product. The product is having a, in case the product means there is two conditions you have to fulfill. One is movable, another one is marketable. So your product is ready to movability, that is a transfer of ownership and possession from one person to another person. At the same time is having two values. A product means there is two conditions. One is movability, another one is marketability. When it is movability, only it is a finished form. Raw and work in progress semis are not accepted by the customers. Only the product is a finished one, that is finished goods. That finished goods is only movability, that is movable from one person's to another person's movability. And also marketability is having some value. So that time you have to need for your product is a finishing stage, and also you are ready to market to the customers. That time you need fund. That fund is the earlier stage firm, that is the startup earlier stage firm that need funding for expenses associated with marketing, maybe market segmentations. You have to identify the more customers perceptions, preference, all these things. You will need fund for market, maybe advertisement, promotional activities, all these things. Not only for the product development, how this product are reached to the customers, you need fund. That fund you have provided by the venture capital finance. That fund name is a startup fund. First one is the idea generation, second stage is the startup, third stage yearly sales and the manufacturing funds. Once that is the third stage in our roundup, that is yearly sales. So your product is reaches to the customers, you need for promotional activities, and also you need for more funds for buying inventories, to converting this inventory into raw material into work in progress. All these things is need for that at the time. That is the first round of fund is provided to the venture capital finances to the entrepreneur, that is yearly sales and manufacturing funds. And the second roundup working capital for early stage company that are selling product but not yet turning a profit. In this stage your product or reaches to the customers, but at the time you are not getting more profit. This is a new product, that product has reaches to the customers. Your product now only familiar to the customers, the familiar customers are also ready to buy the product. And that is a growth stage, that is growing, you need for growth stage, but not a turning a profit. That stage you need fund, that is for second round of stage. The third one is called as methane financing, that is expansion money for a newly profitable companies. Yes, your business is booming, automatically you will expand your operational activities. In case of using a expansions, modernizations, or diversify your product in a different way, so you need more fund. So you automatically your product is reaches to the customers are ready to buy the product, your business is expanded. So for the expansion and modernization purpose, you have to modernize your product. That time you need the fund. The fund is called as a third round fund, and the fourth round is the also called as bridge financing. Is needed to financing going public processes. Yes, development of your business. So totally there is a six round stages of financing provided by venture capital financing. The first one is the idea generation. Second one is your product is coming to the form of finished product are ready to send to the market. Third stage is the sales and manufacturing funds need for. Fourth stage working capital requirement, and the fifth stage you have to reach the customers and you develop your business operations, and finally your business is successfully running into the market. These are the stages of financing in our venture capital financing. Next one, factors determining venture capital requirement. What are the factors to be determined for venture capital requirement? First one is nature of business. What type of business you have to underwrite, or what type of product you are producing, or what is your ideas, what is your methods. That is depend on the requirement of the venture capital. Maybe your product is a new product. Maybe it need more money. Nature of the product is depending upon your product is cyclical product, or anytime there is a demand, a secular product. Some product need for at any time, some product is only need for some particular situation. Cyclical product, seasonal product. So depending upon the nature of business you have to you are mostly depend on technological based, or you are mostly depend on a labor intensive. Some product need more labors, or some product is need for a technological innovations, all these things. So what type of product you have to produce, that product is some product is reaches all the people, some product is only reaches to only some group of people, so it says segmentations. So depending upon the nature of the business, your product is a cyclical product, your requirement is very very high. In case any secular product or seasonal product, you need the fund only at the time of the product is reaches, depending upon the climate situation. All these things you have to consider. Next one is the size of the business. Size of the business means small business, medium business, or large business. Your business is purely based on a small business, your requirement is very low. In case medium and a long type of long term large scale business, its need the funds is very more. So size of the business means your small business or medium business or large scale business. In a large scale business automatically need more requirements in compared to medium and a small scale business. The first one is nature of business. Sometimes you also consider this one also. Your techniques or method is purely based on trading based or manufacturing based or service oriented. In case of service oriented, or in case manufacturing oriented, need more funds in compared to service and trading based. So that type you have to, for example, development of the app that need some amount of requirement is very very less in case of development of the apps related to service sector. But in case your methods are technical to manufacturing, we are introducing the some technological based way, you need definitely more requirement for infrastructure facilities, all these things you need more funds. So nature and size of the business and length of the production cycle means there is a conversion duration. For example, the raw material is converted into work in progress is converted into finished goods. That is a cycle. That is raw into the finished form. So how much time is required? For example, there is a short production cycle, the requirement of the fund is very low. But in case the duration of a cycle is very very high, some product, for example, related to automobiles or chemicals, iron ore, steel, it is the requirement of the production cycle, length of the production cycle is very long. But in case some product, the length of the production cycle, the conversion period is very high. In case the conversion period is very very long, automatically you need more funds for direct labors, direct expenses, direct materials. You have the requirement, you have the holding carrying cost, holding cost, all these things is very high. If the length of the production cycle is very very long, automatically it leads to increase the requirements of your fund. That is, your fund is circulation is very very high more, your operating cycle is also very more. operating cycle means the cycle, that is the cycle is need for operation cycle. That is a raw material is converted into work in progress. Work in progress converted to finished goods. That goods are sold to the customers, and the fund is returned to the returned to your cash. So there is an operating cycle. The length of operating cycle is very high. The requirement is also very high. The operating cycle is very low. The length of the requirement is very low. In case the requirement is very high, at the time you need equity financing. In case the length is very low, you need for a debt financing, or you go for quasi. But some entrepreneurs need more length of production cycle, so there the requirement is also very high. And next one is the seasonal variation. So some product is a seasonal related product, so that time only you need more money for the production cycle or your length of the cycles also. But other time you don't need for money. So depending upon your product is seasonal product, at the time of seasonal time you need more funds. Take case of textiles, all these things, festive season, for example fashion technology or designing or something. At the time of festive season, then you need for more requirements, more requirement of funds for introducing new techniques or new branded or something. So you need that time you need more money. So depending upon the seasonal variations product, not only for that, sometimes paramedical sector is also, sometimes some diseases is on certain time only. So that time the product is also increasing. That time you also need for more monies. And finally, working capital cycle. Working capital means the current asset and the current liability management is otherwise called as liquidity decision. So the working capital is a fund is used for day-to-day operational activities of the business. So you need for cash, bank, marketable securities like current assets, sundry debtors, stock. That is inventory holding period is very very important for working capital. The length of inventory management, for example, neither excess nor deficit. For maintaining for the inventory management policies, you have for example excess inventory holding, it need for carrying and storage. At that time you need more funds. So neither excess nor deficit. In case your inventory is very deficit, affected your production, it affected your sales, automatically it affected your operating profit is affected automatically. It will leads to EPS is down, automatically earning per share is down, automatically it leads to market price per share is down, automatically the value of firm is down. So you have to estimate your working capital in a correct way, how much fund is needed for your working capital. So these are the 5 points, is a very very important point for determining venture capital requirement. One is nature of business, next one is size of business, small, medium and large, and production cycle, length of production cycle. Your production cycle is very short, the requirement is very low. But in case your production cycle is very very long, automatically the length of the need for requirement is very more, seasonal product and working capital requirement. The next topic is development of venture capital in India. The concept of venture capital was formally introduced in India in 1987 by IDBA, Industry Development Bank of India. The government levied a 5% cess on all know-how import payment to create the venture fund. And after that, the ICICI is also started venture capital act, is providing finance for seed capital. That is providing finance for the innovators, acted the same year. Later on, ICICI floated a separate venture capital company. The name is called as TDICI. And the venture capital finance in India can be categorized into following five groups. The first one is those promoted by central government controlled development financial under the control of central government. Example, ICICI Venture Funds Limited, IFCI Venture Capital Funds Limited, SIDBA Venture Capital Limited. This is under the control of central government. Next one is the those promoted by state government controlled development financial institutions. For example, Punjab Infotech Venture Fund, Gujarat Venture Finance Limited, Kerala Venture Funds Limited, and another one is public banks. First category controlled by central government. Second category state government control. Third one is public banks like Can Bank Ventures Funds, SBI Capital. SBI is a leading commercial bank for providing venture capital, especially for the entrepreneurs and the MSME. That is, the name is called the micro, small, and medium enterprises, providing for development of the business, not only for providing large scale business, but also providing the development of the micro and the small business. Also, the SBI Capital Market providing more number of funds to rural areas, and also especially for the development of the women entrepreneurship in India. And the fourth one is the private sector companies is also enter in the field of providing venture capital, that is providing finance for initial development of the business, startup financing. ILFS trust companies and Infinity Ventures India. Some companies, the overseas venture capital fund is also in India is engaged. That is Walden International Investment Groups and HSBC Private Equity Management. These are the financial institutions are providing finance to the entrepreneurs, innovators, businessmen. After screening the viability of the project, these financial institutions are ready to give not only for urban areas and also providing major loans from with the help of microfinance institutions, self-help groups. All these things is used by these commercial banks providing loans. Cooperative sector is also providing venture capital financings to micro business in the rural areas also. So these providing the development of the entrepreneurship, and not only for the development of the entrepreneurship and also the development of the economical development. Objectives of venture capital in there. What's the main objectives? It allows for working together of capitalistics and startup businessmen closely, and for promoting the entrepreneur to focus on making more and more ideas. So it's join hands with the entrepreneurs for development of more and more ideas, development of more new products, new methods, and new plans. And it creates an environment suitable for knowledge and technology based enterprise. Once you have an idea, these financial institutions are ready to give the loans to you. So you have more number of ideas is emerges, and it's very useful to the society for the your knowledge processing, knowledge generations, all these things. It helps to boost scientific technology and knowledge based ideas into a powerful engine of economic growth and wealth creations for the suitable matters. Is one way is to development of the economy. The another way is eradication of poverty and unemployment problem also. So these banks are ready to give the loan. More number of entrepreneurs is coming forward. No more number of businessmen is coming forward to start up the business. So automatically there is a creation of employment opportunities. For example, in case of you have to select one areas, for example, rural areas, how to develop these rural areas. Once you start up the business or industry establishment, then only the infrastructure development is increasing, employment opportunities increasing. Once the employment opportunities increasing, automatically it will eradicate the poverty of the people and improve the standard of the living. So this way the government is thinking for providing these innovative ideas for entrepreneurs to start up new business, all these things. And also its main aim is to play a catalytic role to India on the world map as the success story. So develop the economic development is the main focus, or the economic growth and development is main focus for these venture capital financial institutions. And the rules and regulations of venture capital India is under the control of two major players. One is SEBI, Security Exchange and Board of India. Another one is Income Tax Act 1961. Rules prescribed by SEBI related to working capital financing, or the working capital financing are regulated by SEBI Venture Capital Fund Regulations 1990. The following are the various provisions. A venture capital fund may be set up by a company or a trust after a certificate of registration is granted by SEBI on an applicable made to it. So, what is the first duty of the venture capital finance? To get an registration certificate, a certificate of registration from SEBI. On receipt of certificate registration, it shall be binding on the venture capital fund to abide the rules and the regulations is given by SEBI's Act 1992. There is some conditions is laid down by, that is the rules and the regulations is laid down by SEBI. What is the duty of the venture capital financial institution? Means you have to follow the rules and the regulations that is given by Act. And the venture capital finance may arise money from investor, Indian or non-resident Indian or foreign, provided the money accepted from any investor is not less than 5 lakhs. And next one is the venture capital finance shall not issue any document or advertisement inviting offer from the public for subscription of the securities or units. Next, the continuation of the SEBI regulation. The SEBI regulation permits investment by venture capital funds in equity or equity related instruments of unlisted companies. Listed companies are not coming under the venture capitals, only unlisted companies, and also is financially weak and sick industries whose shares are listed or unlisted. At least 80% of the fund should be invested in venture capital companies, and no other limits are prescribed. And SEBI regulations do not provide any sectorial restrictions for investment. Any sectors you have to start up the business, there is no regulated by the SEBI. SEBI regulations do not provide for any sectorial restrictions for investment except investment companies engaged in financial services. Other type of business, the venture capital institutions are ready to providing finance in the form of equity or debentures or quasis, but financial sector is not coming under venture capitals. And a scheme of venture capital setup as a trust shall be wound up. Once, in case you are not follow the rules and regulation, the venture capital setup or trust should be wound up. Some conditions are when the period of the scheme, if any, is over. If the trustee or of the opinion the winding up shall be the interest of the investors, or sometimes the tax benefit, some of the financial institutions are coming forward for venture capital financing, all these things. So that's way what purpose you have to start at your venture capital financing. Once the purpose is accomplished, you have to wound up your venture capital. And sometimes 75% of the investor in the scheme pass the resolutions for wound up, or otherwise if SEBI so direct the interest of the investors is wound up your venture capital financing institution. And some of the provisions is given by income tax rules. The first one is the Income Tax Act provide tax exemptions to the venture capital finance institution under section 1023 FA, subject to compliance with income tax rules, restrict the investment by venture capital financing only in the equity of unlisted companies. Venture capital financial institutions are required to hold the investment for a minimum period of 3 years. Once you have to invest your fund in any business organizations or any enterprise, you have to invest your money, hold your money for a period of 3 years. And the income tax rules until now provided that venture capital financing shall be invested only up to 40% of the paid up capital of venture capital units, and also not beyond 20% of the corpus of the venture capital financing. And the amendment, after the amendment, working capital financial invest venture capital financial invest only up to 25% of the corpus of the venture capital fund in a single company is not exceeding 25%. There are sectorial restrictions under income tax guidelines which provide that a venture capital finance can make investment only in specified companies. And Indian Venture Capital and Private Equity Association. This is purely related to the associations for venture capital financing. It was established in 1993 and is based in Delhi, the capital of India. It is a member based national organization that represent venture capital and private equity firms, promote the industries within India and also throughout the world, encourage investment in high growth companies, and support entrepreneurial activities and innovation. The main aim is promotion of entrepreneurial development in India. That is the main aim for the Indian Venture Capital and Private Equity Association. All these things is laid down by some conditions, but the focus on Indian Venture Capital and Private Association is focus is development of new ideas, new business, especially for the underdeveloped areas, for to development of the, and at the same time development of the entrepreneurship skill in India. And ICVA members comprise venture capital firms, institutional investors, banks, incubator, angel groups, corporate advisors, accountant, lawyers, all these things. The other venture capital and private equities. The members represent most of the active venture capital and private equity firms in India. These firms provide capital for seed ventures, early stage companies, and later stage for expansion. How does the venture capital work? The venture capital firm typically source the majority of the funding for large investment institution. The investment institution expects very high return on investment, and the venture capital investment companies with high potential, where are the IPOs or merger or acquisition, all these things. The primary purpose for venture capital institution is to promote and development of the entrepreneurs and also develop the business. It leads to develop the economic growth and improve the standard of living of the people and eradicate the below poverty line. That is the main focus for venture capital financial institutions in India. So these are the points related to venture capitals. It's very easy and understanding concept. You go through your books also. This but in our examinations point of view, the venture capital is continually asking one of the questions about these points, stages of financing. Totally six stages: for seed money, startup, first round, second round, third round, and fourth round. So you go through your books in detailed and give some ideas. Sometimes general question is also asking for how the venture capital financing in different areas of entrepreneurship development, all these things. So this is an important question for in this part. The next one is the asset liability management. This asset liability management is simply the financial institutions matched with this asset and liabilities. It's facing some maturity or interest rate risk and liquidity risk is there. How to minimize the risk? These help the institutions to minimize risky exposure and optimize its financial purposes. This is such as banks and insurance companies. Is effectively manage risk arising from their assets and liabilities. The primary goal of ALM is a new techniques introduced in the field of financial services, asset liability management, and one more thing is the securitization. There is a two new concepts are emerging in the field of financial services. The first one is asset liability management. How bank and insurance companies are manage its assets and liability. There is match between the assets and liabilities. So definition: ALM is the process of managing assets and liabilities of a financial institution to achieve its financial liabilities while mitigating a risk. For example, the primary objective of ALM is to ensure that a financial institution has enough assets, such as in case banks or financial institution loans, investment is assets, and cover its liability. It's possible to meet these liabilities like deposits and borrowings. The reason is while maximizing profitability and maintaining the accepted level of risk. In case of financial institutions facing the major risk is interest rate fluctuation, liquidity risk, and also the market risk. How this risk is affected the financial institution, how the financial institution face this risk in the form of its assets and liabilities management based on a swapping, all these things is coming under ALM. The next one more technique is securitization. Two emerging techniques in the field of financing. One is ALM, another one is securitization. Securitization is a financial process where illiquid assets means loans, mortgage, or receivables are pulled together and converted into tradable securities. These securities then sold to investors in the capital market. Is simply illiquid assets is also deal in the stock market. There is a intermediate is there. Yes, financial institutions pull together similar type of asset and sell them to an intermediate, that is special purpose vehicle, SPV. The SPV means that issuing securities, collecting bonds and other backed securities, and these securities are converted in the form of marketable securities. That securities are deal in the capital market. It's simple like an underlying assets. And the next major topic is insurance. Is moving to the last unit, that is the major topic is insurance. But you know very well that it is very understanding and very easy for you, already know very well about the insurance. It's nothing but a contract between two parties. One party is a insured and another party is the insurer. So there is a valid contract between two person. one person is an insured. Who is insured means the person whose life or property is insured with the insurer. Simple like a policy holder. The person who is take the policy, the person name is insured. Insurer is the simple like an insurance company to whom risk is transferred by insured. That is the person who insures the risk of insured is called a insurer. So insurance is a contract between the two person. One person is an insured. That is a policy holder, the person who is ready to take the risk and also taking the policies. The person name is insured. And another person is to whom the risk is transferred to. The person is an insurer. Thus, insurance is a contract between insurer and insured. It is a contract in which the insurance company to undertake to indemnify the insured on the happening of certain events for the payment of consideration. So it is a contract between the insurer and the insured under which the insurer undertake to compensate the insured for the loss arising from the risk insured against. There's famous definitions in the field given by Ghosh and Agarwal. Insurance may be defined as a cooperative form. Yes, more number of persons are joined together for mitigating the risk, for distributing the certain risk over a group or person who are exposed to it. So, the financial hardship should consider insurance. Why we go for insurance? Why the person is taken for insurance policy? The first and foremost is the protecting family after one's death from loss of income. The one person is the income earner person. In case the sudden death of this person, for example, accidents or any other illness, how to safeguard the family? So the first and foremost is the protecting family after one's death from loss of income, and sometimes ensuring debt repayment after death. For example, the person is having a debt. In case he is sudden death, how to pay the debt? So ensuring repayment debt after death and covering contingent liability. Contingent means may or may not. You are not predict what happened to be in tomorrow. So definitely you need certain security in your life. And also for your business is also sometimes there is a fire accident, sudden fire accident, your business, how to safeguard your business, how to recover the losses. So you need for certain hardships to need for everything. So covering contingent liability. Contingent liability means may or may not happen. Contingency may or may not happen in futures. And protecting against the death of the key employee or person in your business. Key employee means the person is an making all the important decisions and resolution in your business. Maybe automatically there is a sudden death of that person, it's affected your whole business operational activities. That time definitely you have to face some losses of your business. So you have to recover these losses and also develop your business. That time you have to protecting against the death of the key employees or person in your business. And the next one is maybe a partnership firm or shareholder of maybe as a partnership firm. In case one of the partner is sudden death, what happened to the partnership firms or co-shareholders? Are these things you have to protect your business? You take an insurance policy for the business also, not only for the person. You take the business on the partnership firms also, key persons also taken. And sometimes protecting yourself like unforeseeable death, health expenses, suddenly you affected some diseases, for your illness, who is recover, who is safeguard you? So you need for some insurance, health insurance is there. So you have to unforeseeable health expenses if need for protecting you. Sometimes some accident, disabilities, all these things is happened, so you need some fund at the time. How to get from others? So once you get the policies, that insurance companies is come forward to unforeseeable protecting yourself against the unforeseeable health expenses, and protecting your home against theft, fire, flood, and other hazards happen, other uncertain things happens, and protecting yourself against lawsuits. Sometimes some problems related to your exchange of monies or transfer of monies, maybe sometimes there is a misrepresentations, all these things you have affected something related to against law, protecting yourself against lawsuits, and protecting your events of disabilities, protecting your car against theft losses, car insurance, and many more. So a lot of reasons a person who is taking for a insurance policy. The first one is safeguard the family's business, and also himself to develop himself to safeguard from the hazardous, that is by any types of accidents, illness, death, or anything, all these things coming. So these financial hardship should consider insurance. Next one is the history of insurance in India. The oldest existing insurance company in India is the National Insurance Company, which was founded in 1906 and is still in business. Now, the Indian National Insurance Company is also engaged in the insurance business operational activities in India, but it was started in 1906. The Government of India issued an ordinance since 19th January 1956 nationalizing the life insurance sector, and the life insurance corporation came into existence in the same year. So in the two, life insurance and the life insurance corporations came into in the same year. The life insurance corporation LIC observed 154 Indian and 16 non-Indian insurers, are also 75 provided societies and 245 Indian and foreign insurance, all in 1972. Start another one is General Insurance Business Nationalization Act was passed in Indian Parliament, and consequently General Insurance Business was national with effect from 1st January 1973. 107 insurers were amalgamated and grouped into four companies, namely National Insurance Company Limited, the New India Assurance Company Limited, the Oriented Insurance Company Limited, and the United India Insurance Company Limited. The General Insurance Corporation of India was incorporated as a company in 1971, and it commenced its business on 1st January 1973. The LIC had monopoly till the late 90s, when the insurance sectors are reopened to the private sector after the liberalization policies LPG. Before that, the industry considered of only two state insurance, life insurance and general insurance. J had four subsidiary companies. With effect from 2000, the subsidiaries have been delinked from the parent company, were set up to independent insurance companies: Oriental Insurance Company, New India Insurance Companies, National Insurance Company Limited, and United Insurance Company Limited. Insurance in India refer to the market for insurance, which covers both public and private sector organization. And the insurance sector has gone through a number of places where private companies is also enter into the field and allowing foreign direct investment. India allowing private companies insurance sector in the year 2000, and setting up limit of foreign direct investment to 26%, which was increased to 49% in 2014. Now it increased to 62% for the FIA and the FDA contribution in insurance sectors. However, the largest life insurance company in India, Life Insurance Corporation of India, is still owned by the government, and it carries a sovereign guarantees for all insurance policies issued by it. And the next one is terms used in insurance. There are the important terms are used in insurance, that is insured, insurer. Insured means that is simple, like an insured is normally insurance policy holder, maybe a person or an individual who seek protection against a specified task and entitled to receive payment from the insurance event of happenings. The insurer means a company. The insurer is an insurance company who is promised to pay indemnity the insurance on the happening of contingencies. Beneficiary means the person or the parties to whom the policy proceed will be paid in the event of death. The person name who is mentioned in your policies as you are the beneficiary after the diseases arise. In case of any contingency, the person name is beneficiary. Contract, yeah, it's a legal contract, simple like an agreement binding at the law between two or more parties is a contract. And the next one is a premium. The premium is the amount which is paid to insurer by the insured, is a consideration to insurance contract, is known as premium. It may be monthly basis, quarterly, half-yearly, or yearly, based on your agreement. Insured sum is a policy money or the face value of the policy amount. This is the maximum liability of the insurer toward the insured. And an peril is simple like that an event that cause a personal or property loss by fire, explosion, collision, or premature death, sickness, floods, or dishonesty, etc. The reason for this assault means is a condition that may create increase or decrease the chances of losses. Exposure is simple like the physical extent of the risk. The risk is arise. The cover note, and cover note means a unstamped document issued by on behalf of insurers as evidence of insurance spending issued on the policies. Damages is simple like the monetary compensation awarded at law for a civil long or breach of contracts. Indemnity means actual loss suffered by the persons on based on the call indemnity. And next one is reinsurance. Reinsurance is a method where the original insurer transfer all or part of the risk to another insurance companies or subjected to reducing the risk. Double insurance means the insured in two or more insurance companies. Reinsurance, double insurance means the implies the subject matter is insured in two or more insurance companies. That is two insurers. But in case reinsurance means original insurer transfer all or part of risk to another insurance company. These are the normally used terms in insurance. Okay. Okay. We have continued the next class. Up to this stage, we have to conclude it. Next, maybe third hour, I think. We have to continue your last unit, insurance, and also your last units. Thank you.
Good morning, students. Am I audible, pa?
Yes, sir.
I think my screen is also visible, no? Check.
Screen is not visible, sir.
Check it now. I think it is visible now. Right? Yes. Can anyone confirm whether my screen is visible to you?
Yes, sir, we can see.
Okay, thank you. Okay, so we are discussing on unit number 5, right? So I need to complete one more item, then we'll discuss the question paper. Pa. Okay. So this is the extension version of maybe next semester you may have a financial derivative. Pa. Okay. So in that it is the part of the paper. Okay. So we are going to discuss on the derivative, especially the options. Okay. So that we are going to discuss now, and then we'll move on to the question paper discussion. Just a minute, hold on. So 5.2. So 5.2, we call it as an option, that is financial option. Okay. So it may be in a commodity option or currency option, equity option, even it may be in a debt option also. Okay. So the name itself very clearly given, it is an optional for the holder. Okay. So whenever I think I'm assuming that you know something about derivative market, right? So derivative market, and let me start with some introduction and we'll move on to the options. Okay. So derivative market is nothing but we can go for a future trading. Okay. Say for example, today gold prices was say were like 7,000 rupees. Assume that I may require gold after 1 year, after 6 months. In that time, nobody knows the gold price, right? Right. So today maybe 7,000 rupee 1 gram. It may be some 8,000. It may be even 6,000 also. So what I am feeling that by anticipating, the future gold price may go in a other way, maybe some 8,000 rupee. So in order to avoid that risk, okay, as a buyer, if I'm able to buy at 7,000 rupee or 7,500 rupee, for me it is better, no, because I don't have money now. So if you are creating an agreement to buy a gold after 6 months or after 1 month, after 1 year, or even 1 days also, that contract is called as a derivative. Okay, derivative of many forms: forward form, future form, option, and swaps. Okay, these are all forms of derivative. Same way, if you have feel that the TCS company shares available now 3,000 rupee, but you had an idea that you have some what you call anticipation that, or you have some understanding about the TCS company share will increase in the another 6 months. This may go to even 4,000 rupee also, but you don't have money now. So what you can do in that time, you can create a contract to buy a TCS share after 6 months or after 1 month or something, anything. Because these are all called as a derivative contract. We creating agreement to buy in a future dates. Same way it can happen in a selling also. Okay. Is it clear? This is called as a derivative format. And if it is in a forward or future form, we call it as a, there is no optional to you. Why there is no optional? The reason is it is a forward and futures. If you had agreement to buy, you have to buy. If you have agreement to sell, you have to sell. That is the first two forms of derivative. Whereas the third form we call it as an option form, it is the optional to you. When it is optional to you, when it is favorable, you can buy. When it is unfavorable, you are not going to buy. Okay. So it is the optional for the buyer, or we call it as an holder. Okay. Let me give a same example. Let me take like this. Assume that today gold was 7,000 rupees. As an individual investor, you are having anticipation that the 7,000 rupee may go to 8,000 rupee after 6 months. So you created a contract to buy at the 7,000 rupee. Today rate, you created a contract and you are planning to buy after 6 months. After 6 months, If the gold price is 6,000 rupees, what will happen? You can buy from the market. No, why should I go with the agreement and buy at 7,000 rupee? Clear up. So the agreement can be valid only when if the gold prices are above 7,000 rupee. If the above 7,000 rupee, I can use this contract to buy at 7,000 rupee. If the gold price is 6,000 rupee, why should I buy at 7,000? Because the agreement says I have to buy at 7,000. So in that time, you can use optional. Okay. When it is above 7,000 rupee, I can buy. When it is below 7,000 rupee, I cannot going to buy. Because buying at 7,000 is the loss for me. No, why should I buy? Okay. So this is called as an optional for the writer. Sorry, we call it as an older. Clear up? So we are going to discuss about there are two type of option. One is call option, another one is put option. It may be applicable for the commodity, it may be applicable for the currency, it may be applicable for even equities also. If it is an equity, it is called as an equity option, currency option, or commodity option. Clear? So India, we have all the three. Equity option we have, that is dealt by MCX, and we have a currency option, and that is dealt by NSE and BSEs are dealing with the currency option. Same we have equity option also. Okay, option is nothing but it's going to give you the writer. Sorry, the holder is the right. Okay, that is what mentioned here. Option give the purchaser or the buyer the right to buy an underlying asset, or it may be securities also, it may be anything. Okay, at a pre-specified price, we call it as an excise price or strike price or the contract price. Okay, so these are all called as an excise price or contract price or the strike price. Let me take the same example. Okay, let me take a same example. Okay, so today gold rate is 7,000 rupees. Assume that it was 7,000 rupees. And you created agreement to sell after 6 months. After 6 months, this price may be 8,000 mean you can buy at 7,000 rupees. That is what you created a contract. The contract will be called as a call option. You had a right to buy at 7,000 rupees. When you can buy? When the price is above 7,000, I can buy by paying a 7,000 rupees. Okay. When the price is 6,000 rupees, why should I buy at 7,000? Is it clear what I'm telling? When the price is 6,000 rupee, why should I buy at 7,000 rupee? Is it clear? In that time, it is not advisable for me. Even the prices are coming down, 5,000 rupee, I'll go by the open market because after 6 months, nobody knows the price information. Okay. The contract price is called as an excise price or the agreement price or the strike price. Okay. So for that, I'm going to pay some premium because it's like in a movie ticket. Okay, nowadays it was not a practice. Maybe in a certain movie ticket, you may get like this. You can pay only the booking charges. Say, for example, the ticket is 200 rupees. Okay, and you booked a ticket for particular show for Sunday, 6 o'clock, particular movie. Okay, and you paid only the booking charge of some 20 rupees. Okay. So you paid a booking charge of 20 rupees. So you paid a 20 rupee to buy a ticket at 200 rupee. Clear? So when you can buy the ticket, because already 1 month before or 1 week before you booked a ticket, and assume that it is all will be based on the demand and supply. Okay. So in particular day, what happened? Nobody's there. So assume that the price went to 100 rupee. Why should I use that on 200 rupee? Because you paid 20 rupee to buy a ticket at 200 rupee. Clear? If the open market prices are 300 mean, you have the right to buy the ticket at 200 rupee. Clear? If the open market price are 400 rupee, still you can have a right. So until which date I can use it? Sunday, 6 o'clock. That show you have to go and you have to show this, what they call the booking information, and you may get a ticket at 200 rupee. So when you are not interested show, assume that the price is just 100 rupee. So in that time, I'm going to show here because if you are taking that, you have to pay 200 rupees. Sorry, if you're taking that agreement, you have to pay 200 rupees, but open market is available at 100 rupees. This is called as a call option. That is, the buyer paid a premium to use the or to buying the particular asset. It may be a ticket, it may be in a share, it may be in a currency, it may be in a commodities also. Okay. So as per the buyer point of view, he paid a 20 rupees. He has a right to buy the asset at strike price. The strike price is the contract price or agreement price. Okay. And it and what do you call the ticket owner, no, that is the theater owner, no. So he called us a put option, call option, right? Okay. So here we discussed about there are two party, that is call option. Holder we called as a buyer, and writer we called as a seller. Okay. So the seller doesn't have a right, only the buyer have a right in the call option. Okay. So there are two type of option here. One is call option. Call option giving a right to buy a particular asset at a specified price on particular date. This is called as a call option. You cannot use it for Saturday. You have to use it only on Sunday, 6 o'clock show. You book a ticket, and that day you are going to take a decision. Whether it is 100 rupee, you can buy spot market. Whether it's a 300 rupee, you can use this token and say that I booked it earlier. You have to give me at 200 rupee. Okay. The theater wallet doesn't have any right. He cannot say, because that is why you paid a premium of 20 rupee. Clear about. So this is called as a call option. Okay. Same way we have a put option also. Put option is nothing, but this is the pay for the call option buyer. Okay. So that is what we said. No, that is, it was mentioned here. No, the C, that is premium what we paid is the minimum loss. As per the older point of view, 20 rupee paid, the 20 rupees loss for him. Okay. So once the ticket price is increasing 300 and 400, 700, whatever it may be, in that time he's going to get an abnormal profit, because the reason is 20 rupee he paid and he locked a price. When it is favorable, he can buy it over in the derivative market. When it is not favorable, he can buy it open market. Okay. That is why this is called as a call option buyer premium. Okay, or we writer premium. Same we call option seller premium. As per the writer point of view, the ticket, what you call the movie theater owner point of view. Theater owner may get a 20 rupees as a premium. Okay. So his profit is very limited, because he can get only 20 rupees. When the share prices are increasing, when the ticket prices are increasing 300 and 400 rupees, he is not going to get any profit. Okay. So that is what the gain and the payoff, the payoff or the call option and the put option. Okay. Same way we are moving on to the put option also. So put option is nothing but it was give the option buyer right to selling some asset. Okay. Right to sell a particular asset. It may be securities or it may be stock also. Let me give us some other example. Assume that you are holding a particular company share. Okay. Let me take the same TCS shares. Okay. So you fear that the TCS share price may go down in 2,500 rupees for another 1 month. Okay. In that time, if you creating an agreement, that is called as a put option. Just a minute, hold on. Okay. Assume that the current price is 3,000 rupee. You anticipation sell at 3,500 rupee. But what is the guarantee that you will get it 3,500 rupees in the 6 months? 6 months, the price may even go to 2,500 rupees also, right? Nobody knows. In that time, you creating a put option, sell asset at 3,500 rupees. Okay, you have the right to sell at 3,500 rupees. Clear up? So when you can sell, actually, assume that after 6 months the share price went to 2,500 rupees. In that time, you had a right to sell at 3,500, because that is why you paid some 500 rupees or 200 rupees premium. When you are not interested to show, or when you are not interested to sell the share at this rate, when the gold price, when the share price went to 4,000 rupees or 5,000 rupees. Okay, in that time, why should I sell at 3,500? Is it clear? When the share prices are below than the put option, I will show interest. When the share price are increasing by 4,000 rupees, then why should I sell it at the open market at 3,500 rupees? Okay. So this is called as a put option. Put option also, we have two people. One is buyer, and buyer have a right and seller doesn't have a right. Okay. So that is what mentioned here. For put option holder, or we call it as a buying a put option. Okay. So buying a put option is a limited loss, unlimited profit for the buyer. Same way, put option seller, limited profit, unlimited loss. In the both the cases, for the call option and put option, the buyer will get a unlimited profit and limited loss, whereas seller will get a unlimited loss, limited profit. Clear up? So same way we discussed about the four forms of derivative. Okay. So this is self-explanatory. Okay. So keep this as our understanding, and we can go through for your exams also. But now we can discuss on, again, there are two forms of derivative. Okay, so that the future price are determined by, there are two value. One is by time value, another one is intrinsic value. The time value is something about the interest calculation we have to consider, and another one is intrinsic value of a gold or intrinsic value of a shares. Okay, so this is all self-explanatory. So with this, I was moving on to the second question paper, which is taken in the last year. Can I go for now? Yes. Can I take it this for now?
Yes. Yes, sir.
This is the 2017 MBA examination. Question papers are mentioned here. So it is available in a website actually. You can download. So what is available in a website that I'm taken here? So strategic financial management, you have a part A, B, C, right? So part A is a short question. Part B is a what do you call it? Big question. And part C, we have a case studies, right? So in the case study, certain case study you may get in the form of leasing, or maybe in the form of merger and acquisition, or maybe in some other format also. Whereas in part A and B, part A probably will get only problem. Part B, sometimes there is a questions also coming, maybe leasing or some other things. Okay. So let me take this. So what are the results of corporate level strategies brings your organization? Okay, so these are all self you can answer. What are the main component of the financial planning? So that is what mentioned in the first unit. Okay, discuss the steps involved in the acquisition process. If you are going to buy any company, and what are the process you are going to take it? So that process you can explain here. You explain the briefly how the financial policy linked to the strategic manager. Okay, so these are all answerable. And briefly explain the objective of the portfolio investment. Okay, so that's also you can again differentiate the leasing with the hire purchase. It is not a it is a spelling mistake, but it is a hire actually. We call it as an hire purchase. So you need to differentiate and leasing and the hire purchase, because at the end of the lease you have to hand over the property, but whereas it is an hire purchase mean you can take the property. Like a EMI based, we purchasing some land or property or car, no? Like this called as an hire purchase. Okay. So briefly explain the component of the project. Sorry, this is next paper. Okay. So question number 7, they are asking about ADR, that is American Depository Receipt. So it is, we call it as when Indian company wanted to get money from the in American market, they supposed to use the ADR fund. That is, they cannot directly get money from the American market. So first they have to issue a ADR that we call it as an American deposit receipt. Through that only, maybe say for an Indian company like a TCS or maybe Adani shares a company, they want to get money from the American. In that time, they have to use the ADR fund. Same way, you can write a detailed note on the strategic alliance by any companies. We discussed, various strategic alliance like a joint venture, business alliances like this and all. No? So that and all you can explain here. Okay. Same way, this is also self-explanatory. I explain the significance of the corporate planning. Okay, so that I'm not discussing. I'll go to directly problem. question number 17 is mentioned like this. The price of a bond just before 1 year maturity is some $5,000. Okay. The redemption value is 5,250 at the end of the period. Okay. And interest payable is, they mentioned, is $350. And dollar appreciated by 2% during the said period, and calculate the rate of return by the taking into the consideration of investor who are in the USA and who are in the Indian. Okay, so we are going to calculate two people. Okay, so since it is mentioned in the dollar, you can assume that this is what happening in a USA. Okay, so the USA citizen may get a certain return. At the same time, if you are Indian citizen, okay, you are going to get a additional of 2 more percentage. Clear? Because the dollar is going to appreciate by 2% in the particular period. Okay, so we are going to calculate what is the return the investor of USA is going to get. Same way, Indian investor is going to get it. Okay, first we will work out the US investor and we'll move on to the Indian investor. Okay, so for this I created. If you want, you can take a screenshot also. Okay, so this is the rate of return of in a USA. So we are calculating, that is redemption value. What is the redemption value is mentioned here? It was 5,250 rupees dollar. Okay, so it is nothing but when the bond is issued at $5,000, while repaying, they are redeeming at a premium of $250. So it is nothing but when you are paying $5,000 to the company, company will repay with $5,250. So for you, what is the profit to you? The $250, no, that is redemption value is 5,250 minus initial price. So you may get a return by redeeming the share is, the bond is $250 plus another interest of $360. So both are your return. That is 5,250. How we are getting that? Minus 5,000. The return is 5,000. Okay. So just a minute. Just a minute. Hold on. Okay. So redemption value is, this is the original value, and sorry, redemption value, this is the purchased value. So on we are getting a difference, and difference is $250, and we may get a return of some 360 rupees as a, what do you call it, the interest, and the total income you may get is 610 for 5,000 rupee. So 5,000 rupee you may get a 610, and we are calculating a percentage. So what is the percentage it is by? It was 12.2%. Okay, simply 6,100 divided by, sorry, 600 by 5,000 into 100 will give you the percentage, but it's showing you 12.2%. So as a US investor, they may get only 12.2% because one is by redemption value $250 they are getting, another in 360 rupee they are getting, $360 they are getting from the interest. So in a particular year, they may get these two as an income, but 250 rupees redemption, 360 is the interest, and total is 16. And how much they are investing? $5,000 they're investing. The 12.2% is the return for the US citizen. Same way, if it is an Indian citizen, mean because you are investing from Indian rupee. Okay, well, so I'll give an example also. Here it is mentioned directly. It will be reversely. Okay, let me take like this. So $5,000 he has to invest, no? Assume that in that time it was 80 rupee $1. Okay. 80 rupee is $1. So how much he has to get back from here? $5,000 at 80 rupee, no? So 5,000 at 80 rupee. So Indian equal to money is how much? 4 lakh rupee. He invested, he taken from the India and converted that into the $5,000 and invested. He may get a two return for what is the 10 is going to get it actually. One is the $250. The total return he may get is 5,610. Is it clear, Appa? $5,000 is just a minute. Okay, so $5,000 is the investment and 610 is the interest. So total amount available after 6 months or the period is 5,610. But by that time, what happened? What is appreciated actually? It was mentioned that rupee got appreciated, sorry, dollar got appreciated by 2%. Okay, so what happened in that time? The 2% mean what? What it will happen? So we are going to calculate the 2% on the 80 rupee. 80 into 0.02. Almost 1.6 rupee. What happened, pa? Rupee got appreciated. So it is going to be 81, not 80 rupees, 81.6 rupee after 6 months. Okay. So that 81.6 you are going to convert here. Okay, so you are going to convert in by that time it was 81.6. So you are going to convert. How much you are going to convert? Calculate. So 81.6 multiplied by $5,610. So how much is going to get? 4,057.776. Is it clear, Appa? So we are converting from the Indian rupee angle. So 4 lakh 57,776. Okay. So that divided by 4 lakh rupee, right? That is what investment, no? 4 lakh rupee into 100. Sorry, that is a small loan, zero mistake. But that is, you'll get a 14.22%. Is it clear? So straight away we can calculate because the currency appreciation is another 2%. For the Indian investor, it is going to be 14.22. Clear up? So this is how we can calculate for the Indian investor as well as US investor. Okay. So if this is clear, we'll move on to the next problem. Next item. I think this is the question paper for the year of 2022 January. Okay. So part A only completely theory question. Part B also theory question. Part B, so yesterday we worked on the same type of problem is mentioned here. Okay. So asset worth of that is 3,43,300 has to be acquired by either by two options. One is leasing the asset or buying through the loan. Okay. Under the leasing option, yearly lease rent is given for almost 1,20,000 rupee as paid for the 5 year. So 5 year you have to pay 1,20,000, 1,20,000. Under the loan option, the company has to pay 14% interest and the loan has to be repaid in the same 5 year. And the tax bracket is given is the 50%. The life of the asset is same 5%, sorry, 5 year, and depreciation and the straight line method, they said same method. So we need to choose which method is good for the business, whether going by leasing, by paying 1,20,000 for the 5 year is better, or leasing is a better. Okay. So we have to answer the same question we worked in the last class also. Okay. So I already shared in the PPT, and the PPTs are in the my chat box. So you can download from that almost same problem. Only thing is that amount is different. That is a 4 year. Now it is a 5 year. The remaining all same. Okay. So you can download from this Google Drive.
Sir, I don't see the link for PPT.
So 1 second, I will paste it. So check now. So it is available in my Google Drive. You can download one. Same problem. Only thing is some amounts are changed. So remaining
Sir,
all
can
same.
you tell from which chapter it is, sir? The sum which you're talking about right now?
Pardon, come again. Unit number
The
4
unit number. Okay.
for venture lease finance and venture capital. Okay, same way in the part C also they asked a problem. The following data in the year of 2022 they asked it like this. 22 January. Same question we are discussing. The following data related to two companies A and B, and they are given like this. Company A, company B, they are given information. There are four information is given to you. One is number of equity shareholders given. So company A 20,000 shares and company B 10,000 shares. So profit of tax is given 60,000 here. They are 20,000. EPS, sorry, price earning ratio is given 20 rupees here, 12 rupee. And the EPS also is given, that is earning per share is given, that is nothing but simply divided by number of shares. That is 60,000 rupees the profit, no? 60,000 divided by number of owner is 20. So they have a EPS of 3 rupee. Same way, 20,000 rupee divided by 10, they have a EPS of 10 rupees. So with this, they are asking you to calculate. Company A is considering the purchase of company B by exchanging a of one share in every two shares in a LB. Okay. So company A is considering purchase of company B. So company A is going to purchase a company B. Clear? Because which company is smaller company by here? Because company B is a smaller company, right? So they have only number of shareholders is just 10,000. Okay. And once company A is purchased, mean there won't be a company B at all. So company A will going to give the shares of company A for the shareholder B. Clear? There won't be any companies called company B hereafter because company B will be liquidated and will be taken by the company A. Okay. So for every company shares of B, they are going to give equivalent company share or they are going to give some ratio. Okay. That ratio is mentioned here. What the ratio? Exchange of one share in every two shares of B. Okay. So two shares of company B will be given for company A. Already how many shares in the company B? 10,000 shares are simply divided by 2 will give you the 5,000 share in a company A. That's all. Is it clear? So 10,000 shares are already there and we are going to calculate equivalent value. That is 5,000 share will be available hereafter. There won't be a 30,000 shares. So already you have 20,000 share from the company A and 5,000 will be equivalent of the TA company. So total will be 25,000. So that we are going to work out now. And you are required to illustrate the impact of the merger on the EPS by assuming that there will be a synergy effect by 20% increase. So they say that the profit will be what is the merger benefit, whether we receive any benefit and all. So that we are going to work out here. Okay. So that also I have worked out and I'll showing with you. 2022 January. So listen carefully. Okay. So first of all, we have to call. If you want, you can take a screenshot also. Okay. So earnings of company A is given. That is EPS of company A is given, and we are multiplying it to the profit. How many profit we have? How much So EPS into number of shares will give you the what is the profit of a company A. So already it is available 60,000 rupee. Okay. Or you can calculate like this also. 60,000 rupees is the profit of a company A and 20,000 rupees is the profit of company B. So that is what they're calculating, either multiplying by number of shares. Sometimes you won't get a profit also. So in that time, you have to calculate EPS with the number of shares. So per company shares are earning 3 rupee and the company has 20,000 shares mean the earnings is 60,000 rupee of a company A. Same way for the company B, they have a 10,000 share. Each company shares are earning at 2 rupee mean and 20,000 rupee was the company B profit. And we are going to calculate the merger effect first. Okay, 60,000 rupee was the earlier profit of a company A and 20,000 rupees the earlier profit of a company B. And now we are merging. Both the companies are now one company, right? So the total profit is 80,000 and they say that 25% is the synergy effect. So both the companies are merged now and the profit is 80,000 and that you are calculating a 25 percentage. Okay, what will be the 25% of 80,000? 20,000 rupee. So the synergy benefit is how much? 20,000 rupee. Is it clear? How we calculating? So we calculating the 20,000 by incorporating the both the company profit. Okay. So both the company have a profit of 80,000 rupee and that we calculating in 25%, that is 20,000 rupee. Okay. So the post merger, that is what they said. No, the problem they said that you make it a profit of 25% after merging. Due to the merging of activity, what happened? But the profit is increased by 25% mean, and the profit is not 80,000 year after, it is going to be 1 lakh rupee. Okay. And that is what the post merger. Okay. So we taken the both the company profit and we increased 25% of both the company profit. That was the new company's profit. That's all. Okay. So now we are going to calculate what is the new share that's supposed to be available after the company. Okay. So we can calculate. So company A is offering one share of every 2 shares of a company B. That is what mentioned here. If you have 2 share in a company B, you may get a 1 share in company A. Clear? So we calculating how many shares per? So 10,000 shares is available in company B divided by 2 because we are going to give every 2 share of B in company A. Okay, so 5,000 share we supposed to give to a 10,000 shareholder. Okay, I'll give like this. I'll give an example like this. Say, for example, I am a shareholder of company B. Earlier, I have 10 shares of company B. Okay, so now I may get 5 shares of company A now. Clear? Because I am going to get a 2:1 ratio. Is it clear? If you have 2 share, you will get a 1 share. If you have a 10 share, you will get a 5 share. If you have a 20 share, you will get a 10 share. Like this 2:1 ratio. Okay. So the total number of new share is how much, pa? Because company A already have a 20,000 share. Company B, they are not giving a 10,000 share. They are giving only 2:1 ratio. And the new ratio is how much, pa? 25,000 shares. Because 20 is existing share and 5,000 share from the company B conversion. And the total share is 25,000. And that is what new shares are available. Okay. So now we are going to calculate what is the EPS effect. Okay. So already we know that the EPS is for a company A is 3 rupee. What is the profit per they have? 60,000 rupee they have a profit and they have a 20,000 shares. So 60,000 divided by 20,000, they have a EPS of 2 rupee now. Sorry, 3 rupee earlier. So now what happened? Their earnings are now 1 lakh rupee because we already calculated the earnings now 80,000 plus 20,000. The earnings are 1 lakh and new shares is 25,000 shares. Okay, so 1 lakh divided by 25,000. So now 4 rupee per. Earlier EPS is 3 rupee, earning per share is 3 rupee because the company have only 60,000 profit and 20,000 shares. Now because of merger, The company shares is 25,000 now. Company profits are now 1 lakh rupee. Okay, so we can able to say that because of the merger, the EPS, that is earning per shares, are now 4 rupee. Earlier it was 3 rupee. Each share of a company earned 3 rupee earlier. Now it is a 4 rupee. So we can say that because of the merger, the company A is going to get benefited, right, Appa? So company A getting benefited because EPS are increased. Is it clear? So if you want, you can take a screenshot also. I'll show the first half now. So this you can take a screenshot. Okay. So the second half. This also you can take a screenshot. Okay. So now this both the question will be completed. So question number 2016. Strategic Financial Management 2017 January. Okay. So part A, there is no problem. Part B, so it was not orderly, but this is page number 1, page number 2, and pair is page number 3. This is page number 3, this side. Okay. So here, they are asking you to calculate the proposal. So NPV and all we calculated, no? So this type of proposal, they are asked you to calculate. Okay. So what is given here? Remington Limited is considering an investment proposal which required 20 lakhs. Expected cash inflows are, and certain equivalent inflows are given here. Okay. First year, second year, third year, fourth year, and fifth year. Cash inflows also given 6, 3, 7, 8, and 9 lakh rupee. Certain equivalent amount also is given, and we need to know the risk rate is 6%, whether we can take this NPV or not. So we'll work out in Excel, but just a minute, hold on. I'll take it. Same problem. So here, 1, 2, 5 years, no? So 5 year. Second one is cash inflows are given. CI. CIs are 6 lakh, 3 lakh, 7 lakh. Just a minute, hold on. I'm 6 lakh, 3 lakh, 7 lakh. 3 lakh, 7 lakh, 8, 9. 8 lakh and 9 lakh. Okay. So at the same time, they given the CI part, that is certainty equivalent. That is CE they given. Equivalent coefficient is given. And this is 0.9. 0.9, 0.85, 85, 0.8, and the last one is 0.75 and 65. Okay, fine. So that is what mentioned here. So we are going to calculate now. So this is the cash inflows. Okay. So 6 lakh, 3 lakh. So like this, they have a cash inflows. So we are going to calculate certainty equivalent cash inflow. Okay. 6 lakh you may expect in the first year, but chances for getting a 6 lakh is just 90% or 0.9. So we are going to multiply by simply this, multiply with this. How much it is, 5,40,000 rupee you may expect. So simply I'm dragging for the remaining sales. So okay. So what is the amount you may expect here? 6 lakh rupee. The equal money is 6 lakh, 5 lakh 40. Same way, you may expect 3 lakh rupee in the second year, the equivalent value is 2 lakh 55. 7 lakh rupee you may expect, but the equivalent value is 5 lakh 60 only, because it's only 80% of 7 lakh is expectable. Okay. Same way, 8 lakh of you may expect, but only 75% of 8 lakh is 6 lakh rupee. So like this, we are multiplying. Now we are going to calculate the what is our PV factor pa? That is 6% apa. So we are going to calculate PV at 6%. So how we can calculate PV rate pa? So this is nothing but go to the calculator. So if it is a 6% mean, you can take 1 divided by 1 plus 0.6. Okay, or 1 divided by 1.06. Power 1, power 2, power 3, we work on the same way here also. This is the equivalent value for the 6% interest. Okay. 1 divided by 1.06. If it is 8% mean 1 divided by 1.08. If it is a 10% mean 1 divided by 1.0. 1.10. Okay. So like this we calculated. What is the value for 0.433? So I'm taking this 4 value and pasting here. That's all. That is the value. Same way for the second year, you can take it like this, or you can use the power n, or this divided by, carefully listen, this divided by, that is 1 divided by 1.06, that divided by 1.06. Furtherly, you can take 1.06. So it was 0.889, 8899. So that 4 value I'm taking here. Okay. Same way for the third period also. That divided by 1.06. So the third year value is 8396. 0.8396. I'm taking 4-digit part because so when you're taking a 4-digit, it will give you accurate answer. So we'll go by in a 4-digit 1.06 furtherly. Otherwise, you can have 1 divided by 1.06 power n, power 1, maybe 2, 3, 4 lines you can calculate, or otherwise you can go by like this also. This is 0.7920. The last one is divided by 0.7472. That's all. So what is this actually? 1 rupee value. Okay. So 1 rupee value is 1 year later. 1 rupee value is 2 year later, 3 year later, 4 year later. Okay. So this is the amount I'm going to get first year end, second year end, third year end, fourth year end. Like this, I'm going to get a 5 different period. You're going to get a 5 different cash inflows. Okay. So this is the 1 rupee value. I'm going to multiply by. This is called as a PV value, present value of a cash inflows. Is how much I'm going to multiply 5,40,000 into 9433. Okay. So that is new value. What is that value? Today value of 5,40,000, which I'm going to receive after 1 year. Today value of 2,55,000, which I'm going to receive after 2 years. Same way, why we are converting today value? Because we are going to take investment decision by today. Because today we are going to spend 20 lakh rupee. I just mentioned 20 lakh rupee, no? So 20 lakh rupee I'm spending today. Even though you are spending 20 lakh rupee, but you cannot take like this because 6 lakh, 3 lakh, 7 lakh, like this, if you are total. This is the total of how much actually? The total of 33 lakh. It's look like you are able to get a profit of 13 lakh because your investment is 20 and you are going to get a 33 lakh. Mean profit is 13 lakh. You may come to a conclusion, no, but that is not original case because there is a risk involvement is there. So only 90% of 60,000 6 lakh may come. 85% of 3 lakhs may come in the second year. 80% of 7 lakh may come in the third year. Like this we taken, and that value is like this. Okay. So 25 lakhs is expectable, but that is not a today value because it is all going to happen after 1 year, 2 year, and 3 year and 4 year. Clear? So we are converting that into the today value by taking the 6% interest, and that total you have to get it back. Okay. So that total is how much? It was 21 lakh 18,000. So this is called as a total PV value, present value of an CI. Okay. Otherwise, PVCI also we can mention. PVC, present value of cash inflows, minus less. You are going to say outflow. How much we are spending? Outflow. How much we spending? 20 lakh. We spending a so that 20. Okay. You have outflow of 20 lakh rupee, and the remaining, usually outflow will be amount, but you can mention in the negative amount. Okay. This is your negative amount, and remaining amount is called as my NPV. That is net present value. That is after deducting your outflow, you calculating NPV. NPV is how much? So difference between these two will be your NPV. That's all. So you taken two conditions here. One is first you converted equivalent coefficient. Second, you converted time value of the cash inflows, and then you are taking a decision. Today I'm spending 20 lakh rupee. Even though you are adjusted 2 times, it is going to give you the 21 lakh. So the profit is how much? It is the profit part. It was 1 lakh 18,795. That is what your profit. So we can say that NPV is 1 lakh 18,000. So we can take our project. So in that way, we have to approve your project. Okay. So if you at all any doubt, again, these are all lengthy questionnaire. So we need to understand these scenarios, and you can try to give an answer also. So if it is a problematic, we can. And these are all the testing your what I call the subject knowledge, how you taken this subject in a very efficiently. Okay. So by this, we say that we are completed the syllabus, and we covered the syllabus. We cannot say completed, we covered the syllabus, and we discussed the 3 to 4 questions actually. Okay. So if at all you have any doubt, let me know. Otherwise, we can conclude the today class. I think this is my last class. I completed the 6 hours. This is my last class also. Do you have any doubt?
Sir,
You can download that PPT. Yes.
sir, sir, the percentage of theory and problem 60 plus 40 or 80 plus
No.
20?
It will be. You can expect some 25 to 30%, not a 60-40.
Okay, sir. Okay, sir. Thank
Some
you.
30%. There is a chance. Not
30
beyond
Uh,
that.
can you please
Mm.
provide us the access for that file, drive file?
Yeah. 1 second. Huh?
Okay.
So it is there actually. I given access. It is there in my drive. 1 second, I'll share that link. You can download. If it is not able to download, send a request. I'll give a link. I'll give you the PPT.
I have sent the request.
Okay, let me check it out. Okay, I'll give you the request. No issue. Okay, thank you.
Thank you.
I'll take care of. Thank you.
Thank you, sir.
Thank you. Thank you.
Do we get the access for all the chapters PPT or just the
No,
4
that I'm not
chapters?
prepared a PPT. Not prepared a PPT. So this is
Okay.
only for the leasing finance. So I have covered
Okay.
only your textbook. No, so I was taken from your textbook alone. So better to go by textbook. That is where we called as in a Bible of your chapter. So go by in a
Okay.
textbook.
Okay.
Mostly the question paper setter they will take from your textbook alone.
Okay. Thank you.
Okay, I'll give you PPT. No issue. Okay, thank you.
Thank you, sir.
Thank you. We'll meet you. Thank you.
Thank you.
Good afternoon. Good afternoon. Good afternoon. Good afternoon. Good afternoon. Good afternoon to all. To start the class. Hello. Good afternoon. Good afternoon to all. Vijay Murugan, are you there? Hello. Anand sir, are you there? Bharani,
Hello.
to start the class.
Yeah.
Yeah. Yeah, morning session we have discussed about the one of the important financial services is insurance. It's simple like a contract between the two parties. One party is the insured, the person who is a share of risk or safeguard his life, and the person name is called the policy holder. And another one person name is called as the insurer. It's a simple like an insurance company. We have discussed about the definitions and the financial hardship. Why should go for taking insurance policies? All these things. History of insurance companies in India and the terminologies used in insurance now. There is some characteristics of insurance. The first one is the sharing of risk. The risk is uncertain, but insurance is a cooperative device to share the burden of risk, which may fall on happening of some unforeseen events like death or something. So insurance companies coming forward to sharing of this risk. The second one is the cooperative devices. Yeah, insurance is a cooperative form of distributing a certain risk over a group of persons who are exposed to it. So a large number of persons share the losses arising from a particular risk. The next one is large number of insured person. The success of insurance business is purely depends on the large number of persons insured against similar. Let's take a case of life insurance, a health insurance, accident insurance. So large number of people are joined together, insured against the similar risk. This will enable the insurance company to spread the losses of risk among large number of person, that keeping the premium rate is also very very minimum. And next one is evaluation of risk. For the purpose of ascertaining the insurance premium, the volume of risk is evaluated. For example, we are going to take the policy of life insurance. Depending upon your age, maybe your age is elder age or younger age. So the evaluation process is underwent by the insurer. So for the purpose of ascertaining the insurance premium, the volume of risk is evaluated, which forms the basis for your insurance contract. And next one is the payment of happening of specific event. On happening of specific event, the insurance company is liable to make payment to the insured. For example, you take up life insurance, the deceased by the person, sudden death or anything, the insurance company is liable to pay to the or pay to the insurance claims to the beneficiaries. In case of a fire insurance or marine insurance, it's happening. So the payment of happening of specific event. And the next one is the transfer of risk. Insurance is a plan in which the insured transferred his risk to the insurance companies. This may reason is for the economic loss or personal loss. All things there is a sharing of the risk, transfer the risk to the insurance companies. And protections against risk. Insurance provides protections against risk involved in life, material, and property. Maybe it is a device to avoid or reduce risk. It is not possible to avoid the risk. It is mitigate the risk. So the insurance companies come forward to reduce the risk on your loss, not prevention of risk, prevention of loss. Insurance companies is coming forward for prevention of loss arising on risk. And the next one is insurance is not a charity. Insurance company not give donation to the beneficiary. Charity pays without consideration, but in case of insurance, premium is paid by the insured to the insurer in consideration of future payments. So there is a mutual good faith between the two person, insurer and insured. So there is a considerations between insured and insurance. It is not a charity, it's like donation, all these things. At the same time, insurance is not a gambling. Gambling is illegal, which gives gain to one party and loss to others. But insurance is a valid contract between the two persons, insured and insured. The contract is clearly mentioned indemnify arise of loss against losses. Moreover, insurable interest is present in insurance contract. It has the element of investments also. So insurance is not simple like a gambling. Gambling is illegal. Insurance is a valid contract between the two persons and also the mutual considerations between the two concepts. So it's a legal contract between the persons. And finally, there is a social device. Insurance is a plan of social welfare and the protection of people who have suffered losses or risk arising of life or properties or anything. So these are the major characteristics of insurance. And next one is the functions of insurance. Normally, there is two important functions. One is primary functions and secondary functions. Primary function, there is a 3 points. One is insurance provides certainty, insurance provides protection, and risk sharing. Yeah, insurance provides in case raw risk is arise, the insurance companies provide certainty of payment at the uncertainty of losses. Suddenly death by the income earned person in your family. Who is safeguard the family? Who is giving a benefit to the family? So the insurance company is coming forward, provide certain payment to remove all uncertainties in this family arising after the death of the deceased person. So the insurance provides certainty at the uncertainty of losses. And insurance provides protections to the family. Say, for example, one person is an income earner person. He suddenly dead. What will happen to the family? So the insurance, he is taking the policy. The insurance companies is come forward, provide protections against the families. It's an disease. Same thing like businessman. Suddenly is affected by fire, or in case goods transferred by ship, marine insurance. There is number of insurance is there. So it's provide protections to the families or businessmen for safeguard is doing his business. And the final next one is the risk sharing. The risk is
Good afternoon. Good afternoon. Good afternoon. Is there anybody on the line? Shall we start now?
Yes, sir.
Very good afternoon. So yesterday I was telling about the present value table, no? Do you remember that? How to locate the values on the present value table. Do you remember that? Hello? Am I audible? Am I audible? Is there anybody on the line?
You're audible, sir.
Yes. Yesterday I was telling about the present value factor. How to locate the present value factor in the table, no? Could you remember that? While we work out the problem under internal rate of return method, how to find out these values, table values, about which I said tomorrow I will let you know about that. Do you remember that? No, I don't think you remember. Okay, leave it. Let us now move on to the today's topic, crashing of a project duration. I requested you all to bring the study material of operation research. Do you have the study material with you now? Do you have the study material with you? Okay, leave it. So this is the continuation of our fourth unit, under which yesterday we have discussed about network construction of a network diagram for a given problem, and then construction under CPM as well as PET, and how to find out the critical path, about which we have discussed in the last class. Now, in continuation of that, crashing of project duration. which is also very important from the examination point of view. Problems may be asked in this area. Okay. So, what is the meaning of this crashing of a project duration? Let me explain this now. So, when you work out the problem, what happens? You will be given duration for each activity. With the help of the duration only, we have constructed the network diagram and calculated the critical path also. You know, critical path is the path which taking the longest duration to complete the project. So that is the project completion time, otherwise known as. So in every activity, the duration will be given. So based on that only, the project completion date will be considered by taking into account the critical path. Now, the question is it possible to complete the project before the total project completion time required as per the network diagram? So given the duration we have taken, based on the duration we have constructed a diagram, network diagram, and we have calculated the total project completion time. Now that the client wants to reduce the total completion time and complete it before that time, he may require you to reduce the time by 3 weeks, 5 weeks, 4 weeks, something like that. Some requirement may be there to shorten the total project completion time. So if you could do so, that is called crashing of a project. Crashing of project duration. So what this crashing of project duration is, it is the process of shortening the time to complete a project. If you shorten the total completion time of the project, that process is known as crashing. And it is usually achieved by putting into service additional labor or machine to one activity or more activities. So how can you do this? Means we have to employ more number of resources in the form of labor or machine, etc., so that you can reduce the time. So crashing involves more cost. So when you employ more additional resources like labor and machine, then naturally it involves higher cost, more cost. Therefore, a project manager would like to speed up the project by spending as minimum extra cost as possible. So two things are taken into consideration. On one side, the time is to be reduced. On the other side, the cost should be kept as minimum as possible. So by keeping in mind the total cost of the project, to keep it total cost as minimum as possible, the project manager would like to speed up the project by employing additional resources. This process is known as crashing of the project duration. This seeks to minimize the extra cost for completion of a project before the stipulated time. So whenever the client wants to complete the project before the stipulated time, so we have to employ more resources that requires more amount of cost. So simultaneously, what the project manager has to do, ensure that project is completed before the stipulated time as well as at the minimum cost as much as possible. This process is known as crashing. How this crashing is to be done? Let me now explain with the help of an example. Is the problem visible on the screen now? Is the problem visible?
Yes, sir, it's visible.
And let me read out the problem. So quickly note down the values. If you have a notebook, quickly note down the values so that we have to work out this problem now. A project has activities with the following normal and crash time and cost. So here what happens, various activities starting from A to H are given, predecessor activities also given, normal time to taken for completion of a project is also given, crash time, that means shortened time, how much it can be shortened. that time is also given. Then normal cost is given, crash cost also given. So let me just explain one particular activity. If you take the case of activity A, normal time required is 4 weeks time. It can be shortened by employing additional resources like labor and machine. How much it can be shortened? Instead of 4 weeks, it can be done in 3 weeks. Whatever you employ additional resources, not less than 3 weeks it will take. I mean, below 3 weeks it cannot be reduced. So maximum from 4 weeks to it can be crashed to 3 weeks. Similarly, when you go to cost, normal cost is 8,000 rupees. Then crash cost, that becomes 9,000 rupees, which means when you employ additional resources, more amount of money is to be spent. So normally 8,000 is to be spent, whereas if you crash it, then it should become 9,000 rupees. Like that, crash time, normal cost, crash cost for each activity is given in the table. Just quickly note down this, please. Once you complete the task, tell me immediately. I will move on to the further slide. If you have the study material, you can refer to that. Otherwise, note down quickly. I will tell you how to work out this. Note it down.
Yes, sir.
Okay, you tell me now. You may expect this type of problem in your compulsory question. Shall I proceed now? Okay. So now that first step is to find out crash cost per week of each and every activity. Crash cost per week is to be calculated. Let me now explain how to calculate this so that you can complete the task. Now you take the normal time and crash time. Take the difference. For activity you take, what is the difference between normal time and crash time? Anybody? Say normal.
Normal time is higher than the crash time.
So listen, for activity A, normal time is 4 weeks, crash time is 3 weeks. What is the difference I am asking? Say 4 minus 3, 1. You got my point or not?
Yes, sir.
The difference between these two, 4 minus 3, 1. Similarly, you tell me the difference in cost between normal cost and crash cost. How much?
minus 1000.
Don't put minus. Crash cost by minus normal cost, like that. From higher value, you have to take the lesser value. 1000.
1000, 4000.
1000. Okay. Now listen. The crash cost per unit is to be calculated now. How means the difference in cost by difference in time. Difference in cost is 1000. Difference in time in 1. 1000 by 1 is equal to 1000. You got my point now?
Yes, sir.
Similarly, you find out for B and tell me what is the crash cost per unit for B.
2000.
2000, exactly. Like that, you have to calculate for all this. Okay. Now you see, before calculating that, we have to construct the network diagram. See whether it is visible on the screen now, network diagram. No?
No, sir.
Just a minute, just a minute. Is it visible now?
Yes, sir.
Yes. First, we have to construct this network diagram. Take down this diagram, please. Take down this diagram and find out the critical path, please. Then only we have to proceed further. Just draw this diagram by seeing that and find out the critical path. There are two paths. To find out the total time duration for each path and tell me which is the critical path.
Path 2 is the critical part. That is ACEGH.
Yes, sir. One A, B, D, E. Sorry.
ACEGH.
Okay.
That is the critical path.
Okay. The total duration is 25 weeks, I think.
Yes, sir. 25 weeks.
So that is a critical path. Okay. Okay. Now let us move further. So this is the path. These are the two paths which you have calculated now. So okay.
Yes, sir.
The critical path is given then, and non-critical activities also there. B, D, and F are non-critical activities. Am I correct? Okay.
Yes, sir.
Now we have to calculate crash cost per unit, which I have told you, explained. Now you see two more columns are added to this table, and crash cost per unit is calculated the last column. Just go through this and add this column with your problem now. The last two columns you can add to the problem. Last three columns. Difference in cost, difference in time, then crash cost per unit of time. Last three columns you add to your problem now. Once you complete that, you tell me. Let me move on to the next one. Completed. Once you complete that, you please tell me.
Done, sir.
Okay. Now what happens? The critical cost per unit of week is arrived at the last column. I will read out, you check whether it is correct. 1000, 2000, 1000, 1000, 1000, 500, 6000, 3000. Am I correct?
Yes, sir.
Okay. Now you tell me which are all critical activities of all these critical activities that comes under critical parts. A, then
CEGH.
A, B, then sir, G. What is that?
Yes, sir. A, C, E, G, and H.
A, C, E, G, H. Correct? A, C, E, G, H. Now
Yes,
you
sir.
take the crash cost per unit of these activities. Tell me how much it is. For A, how much? Crash cost per unit for A. How much? How much it is? So you said you have taken down the table, last column. For A, what is the crash cost per unit?
1000, sir.
1000. Then for C, how much for C?
It's 1000 again, sir.
1000. For E,
2000, sir.
sorry, for G,
It's 6000.
6000.
And
For
for H,
H,
3000.
now
3000,
among
sir.
this crash cost, which is the least one?
1000.
1000. 1000 comes for 3 activities, no? For A,
Yes, sir.
for
For
C,
A,
as well as for, I think for 3 activities you are getting 1000. A, C, E, G, H. A 1000, C 1000, E also 1000. Right? So 1000 is the least crash cost per unit. It comes for three critical activities, A, C, and E. Now, one among them we have to crash out. One among them, either A or C or E. Do you got my point? You have to choose that critical activity whose crash cost per unit is least than others. So here we have three critical activities like that, A, C, and E. Now among them, we can crash out only one first, either A or C or E. All are equal, so there is a tie. When there is a tie, you can use your discretion arbitrarily. You can choose anyone. So let us choose A, activity A for crashing. Crashing means instead of 4 weeks normal time, it should be completed in 3 weeks. That is the meaning of it. Do you, understand this concept now? I repeat,
Yes, sir.
listen carefully. Among the critical activities, the critical activity whose crash cost per unit is least than the other should be taken first for crashing. Here in this case, we have three critical activities having the same least cost, 1000. So arbitrarily we can choose anything. We are going to choose A, activity A. Activity A can be crashed for how many weeks? How many weeks you can crash it? What is the normal time? What is the normal time for activity A?
One, sir.
Four, sir.
Activity,
Four.
4 is the normal time. Crash time is 3. So 1 week only you can crash it, not more than that. Okay. So you can shorten the duration of activity A by 1 week. Instead of 4, you take it as 3. Now you listen. The revised network diagram is written here. Is it visible now? Revised network diagram.
Yes, sir.
So what happens, you see, for A, the duration has been changed from 4 to 3. Am I correct? Other things remain the same. Only activity A is crashed by 1 week. Therefore, the revised time for A is, instead of 4, it is written as 3. Right? Now you tell me which is the critical path. Again, we have to calculate the critical path based on the revised network diagram. If at all you want, you take down this diagram quickly, draw this diagram roughly, and work out the crash time. Critical path. Tell me now which is the critical path and what is the duration, total duration. Others in the same diagram, you can, strike out the original value. Below that, you can write the revised value. And then you can calculate the critical path easily. Just 1 week will be reduced. Instead of 25, it will become 24. Right? Shall I proceed now?
Yes, sir.
Instead of drawing separately another diagram, in the same diagram, first we have drawn no. Strike out the value 4 under A and write 3 below that. Then the critical path will change like 24 instead of 25. 1 week will be reduced in the second path. In the first path, whatever it is. Now you tell me which is the critical path again now. Say once you revise the network diagram, there is a possibility that the critical path may also change. There is a possibility. Therefore, every time when you revise the network diagram, you have to find out the critical path again and again. Now tell me whether the same critical path continues or not. Yes, please. Previously, A, C, E, G, H are the critical activities. Route is 1, 2, 3, 5, 7, 8. Now, after revision of activity A from 4 weeks to 3 weeks, tell me whether the same critical path continues or changes. Tell me, please. What is the total project duration now after revision? Anybody? Anybody, please? Is it visible on the screen or not?
Sir, can you repeat, sir? I didn't get, sir.
Now, is it visible on the screen or not, the diagram?
Oh, yes, sir, it's visible.
That's what I am telling. By taking this diagram, you tell me which is the critical path. What is the total duration? Previously, what was the total duration? What is the critical path? Now, what, after revision, which is the critical path? What is the total duration? That's what I'm asking. Previously, we had 25 weeks as the critical path, total project duration. The critical path was 1, 2, then 4, 3, 5, 7, 8. Am I correct? See, when you are not responding, what can I do? Say whether it is.
No, yes, sir.
Yes. And now it is revised. What is revised? The time duration for activity A is reduced from 4 to 3. Now, what is the total duration? I am asking.
24 weeks, sir.
24. And next question, whether the same path remains the critical path or not. Same only remains critical path because the other one's duration is 19 weeks only. Do you got the point?
Yes, sir. Yes, sir.
Then again, if possible, further we can reduce it. If possible, further we can reduce it. There is a possibility because critical activities A, C, and E, these three activities are having least cost per unit of crash time. Therefore, you can take up another two activities, that is either C or E. A is over now. A cannot be further reduced. Therefore, now let's move on to C and E. What is the least cost? Both are having same amount, 1000, 1000. So again, among the two, because there is a tie, both are equal. So among the two, we can choose any one arbitrarily, as we did in the previous case. So among the two, C and E, let me choose C again now. C. Now tell me from the table, for how many weeks C can be reduced, crashed rather. For how many weeks it can be crashed? C. What is the normal?
1 week, sir.
Yes, yes.
For 1 week.
1 week, 1 week. So now crash it by 1 week and revise the diagram again. So instead of 4, you put 3 under C and find out what is the total time duration now. Let me show the revised diagram now.
23 weeks, sir.
No, it is 23 weeks. Fine. Okay, okay. Still, the path remains the critical path, right? Same path remains the critical path. Am I correct?
Yes, sir.
Yes. Further, we can reduce it. Further, we can reduce it. Now, the question is, how long we are going to reduce it? How long we are going to reduce it? Now we have to refer back to the problem now in this case. What was asked in the problem that we have to see. Now let me go back to the problem so that you will come to know. Is the problem visible on the screen now?
Yes,
Is
sir.
it visible? Yeah. Now if you read the problem, a project has activities with the following normal and crash times and cost. Determine a crashing schedule scheme for the above project so that the total project time is reduced by 3 weeks. So if you crash activity A, it can be reduced by 1 week. Again, we can crash activity C also by 1 week. So again, it can be reduced by 1 week. So already 1 week in A, 1 week in C reduced means 1 more week we can do. Now again, we have to go for critical activities. All the critical activities are E, G, H. These are the other critical activities. A, C, E, G, H. A and C reduced already. Now E, G, H are there. Which is the least cost among the three? I repeat, listen carefully. In the problem, it is given that you have to reduce the project by 3 weeks only. Right? Now that we have done crashing of 2 weeks, 1 week in activity A and 1 week in activity C. 1 more week we can crash it as per the requirement. That 1 more week can be crashed in other critical activities. The total critical activities are A, C, E, G, H. Among them, A and C already crashed. Therefore, we have the option before us E, G, H. Among E, G, H, which is having the least crash cost per time per week. Among E, G, H.
E has it, sir.
E. Now E can be reduced. E can be reduced. Now tell me, how long E can be reduced, or what is the crash time for E activity E? For A 1 week,
It can be reduced to 2.
it can be reduced by 2 weeks, but we can reduce it only by 1 week because already we have exhausted 2 weeks. Totally, we can reduce it only by 3 weeks. Already 2 are over, so 1 more week can be reduced from E. Do you understand this now?
Yes, sir.
E can be reduced by 2 weeks, but our requirement is only 1 week. So you can take only 1 week, reduce from that. So now revised diagram is to be written from E, instead of 6, you make it 5. And tell me what is the critical part now again. So that will be reduced by 1 more week. So the total time will be 22 instead of 23 now. So more than that, you need not crash it because the requirement given is only 3 weeks. So from 25, it is reduced to 22. Still the same path remains the critical path. Am I correct? Still the same path remains the critical path. Do you agree with me or not?
Yes, sir.
Even after reducing 3 weeks, the same critical path continues to be the critical path. Right? Now this problem is there in your study material, page number 300, operation research. You can go and refer it further, and another 2 more exercises are there in that. You can try to work out that also, so that you will be familiar with this concept now. So this area you can expect in your examination question paper. Suppose, now listen, suppose instead of 3 weeks, if it is given as 3,000 rupees, then also till you exhaust 3,000 rupees, you can go on reduce the time by crashing certain activities, key activities. Critical activities only can be reduced either by on the time basis or by cost basis. Either of these. The next example in your study material will be on the cost basis. So you just try to work out and understand the things now. Shall I move to the next part of it?
Yes, sir.
Yes. Now, is it visible on the screen? Anything?
Yes, sir.
Yes, sir.
What is in there? Nothing. Wait, just a minute. Is it visible on the screen now?
Yes, sir.
What is that? What is that?
It's in project appraisal process.
Steps in project up. Okay. So let me continue this. So another two more concepts are there in unit number 4, and after that we have to move to the unit number 5. Steps in project appraisal process. This is important from the examination point of view. Listen. Say, what is project appraisal? Project appraisal is the process of assessing or evaluating the feasibility, risk, and potential impact of a proposed project before it is approved and implemented. It is the kind of assessment that we make about the feasibility of the project, risk involved in that, and potential impact that it can create on the society and other environment of a proposed project before it is approved and implemented. Then this process involves evaluating various aspects like feasibility, risk, etc. I told, with the view to ensure that it is viable or it is cost effective, and it is also aligning with the objectives of the organization. So to ensure that this project will be viable, cost effective, and it does not go against the principles of the organization. It is aligning with the objectives of the organization. So this process is known as project appraisal process. I think you got it now. Now, what are the steps involved in this process? The list of steps is given on the screen. Now, let me explain this one by one. The first step is identification of the project. So, first of all, recognizing the issue or the opportunity that the project aims to address is the first step. You have to identify the problem exactly. You have to recognize the issue or opportunity that the project aims to address. Then develop the initial idea for the project, including the purpose and scope and expected outcomes. This is called identification of the project. I repeat, recognize the issue that the project aims to address, or recognize the opportunity that the project aims to provide, and then develop the initial idea for the project, namely purpose, scope, and expected outcomes. That is the first step. The second step is feasibility study. Feasibility means viability, whether it is viable. So under feasibility study, we have to take up technical feasibility, economic feasibility, operational feasibility, legal feasibility, and environmental feasibility. So these are the factors which we have to consider under feasibility study: technical, economic, legal, operational, and environmental factors. Say, for example, as far as technical feasibility is concerned, we are assessing whether the project can be successfully implemented using available technology or available expertise or available resources, or else do we need any other new technology to be procured. This is what we have to assess now. Whether existing technology is enough, existing expertise and resources are enough, or else we need something more. This is what we have to assess under this case. Then economic feasibility, the evaluating the potential of the project for generating the financial benefits like return on investment, that is to be analyzed under economic feasibility. And legal feasibility, ensure that this project complies with all the relevant laws and regulations and standards, regulatory standards. So you should not go against any law of the country, any regulation of the country, any standards fixed by the country. That is to be ensured. Then operational feasibility. If the organization has the necessary operational capacity to execute and manage the project effectively, that is to be assessed. Whether the organization is uh, having the necessary capability to execute and manage the project effectively, that is to be determined. Then comes environmental feasibility. Considering the environmental impact of the project, ensuring the compliance with the environmental regulations are coming under this environmental feasibility. So what is the impact on environment and what are the compliance procedure to be followed for environmental regulations? All these things come under this feasibility study. Then comes the third step, risk assessment. Identify the risk first, identify the potential risk and uncertainties that may arise in future and that may also affect the success of the project. So that is to be identified first. Then analyze the risk. Quantifying the potential impact and likelihood of identified risk is called risk analysis. Once you identify some risk, quantify it. In what way, to what extent it will have an impact. It will affect the success of the project. That should be quantified. Then mitigation strategy is to be developed. Once you know the quantum of risk and the nature of risk, then you have to devise strategy to either minimize or to transfer or to avoid the risk wherever it is possible. Then comes fourth step, cost benefit analysis. Here financial analysis is being done. That means total cost of the project, that is total cost means revenue expenditure as well as capital expenditure in the form of operational expenditure, maintenance expenditure, capital investment, everything is to be estimated in advance. Then what is the benefit that we are going to derive out of this? That is called expected benefits in the form of revenue, increased revenue or cost saving or environmental benefits or social impact. These are all called the benefits that is to be estimated. Then internal rate of return and net present value methods can be used for estimating this cost and benefits. So this is all about financial analysis. The next step is market and demand analysis. Market assessment, market analysis. That means understanding the target audience of the product, of your product. You should understand who are your target audience, and you should also analyze the demand trend for your product, customer requirements, and what is the landscape of competition. All these things are to be analyzed under market assessment. Then comes market research. Once you gather data about the consumer requirement, consumer behavior, consumer preferences and expectations, then we have to determine the potential success of the project in the market. So that research work is to be undertaken. Then comes demand forecasting. That is estimating the future demand for the project's output is called demand forecasting. If necessary, you can forecast your demand also. So this is about market and demand analysis. Then comes the sixth factor, social and environmental impact assessment. So whenever you carry out the project in the execution process, what is the potential social consequences of the project? That is the effect on local communities, or effect on stakeholders, or effect on employment creation. These are called social impact, that is to be evaluated. Then comes environmental impact similarly. So the uh, project is going to use the resources. Resources are given in the environment. From the environment, it is going to take up the resources. By using that, sometimes ecological disruption may arise or pollution may be created. So these are all to be considered. And what is the impact that it may create on environment? That is called EIA assessment. Environmental impact assessment is to be made. Then the seventh step is stakeholder analysis. We have to identify the stakeholders as we started in the beginning itself. Who are the stakeholders? The parties who are interested in the project success are the parties who may be affected by the failure of the project. They are called stakeholders. Say employees, local communities, customers, suppliers, investors, government agencies. These are all called stakeholders. You identify who are your stakeholders, and next one you have to identify the needs and expectations of the stakeholders also, and then keep them informed about the project thoroughly during the execution of the project, throughout the execution of the project life cycle. Then the eighth factor is project structuring. You have to design the project now. That means outlining the specific steps, timelines, and the resources required for the smooth execution of the project are to be made. That is called project design. Then comes appraisal reports. So once all these things are over, prepare a detailed project appraisal report, which will contain findings, analysis, and recommendations. So what was the analysis made? What is the finding? And what is your recommendations and suggestions? These are to be, depicted in the report called appraisal reports. Then comes decision making and approval. Once the appraisal report is submitted, the project appraisal report is reviewed by stakeholders, and then stakeholders will take a decision finally. They may either approve the project or reject the proposal. Once it is approved, then comes the 11th step, implementation and monitoring. So once the project got approved by the stakeholders, a detailed implementation plan is to be developed, like budgets, timeline, milestones, etc., are to be clearly developed. Then monitoring and control. So once the project is planned and executed, in the process of execution, regular monitoring and evaluation of the project's progress during the implementation stage is very, very essential to ensure that it stays on track and meets the objectives. Not only meets the objectives of the organization, but also meets the expectations of the stakeholders. So this may include performance review or audit and progress reports. Through that, you can, these are the tools. Performance review, audit, and progress reports are the tools through which it can be monitored and controlled. Then the 12th step, post-implementation review. Once the project is executed and completed, after completion, assess whether the project has achieved its intended outcome and benefits or not. That is called post-implementation review, impact evaluation, otherwise known as impact evaluation. After the project is completed successfully, the project manager has to assess whether the project has achieved its intended outcome and benefits or not. Then, not only that, you also identify the successes and the challenges. That is called lessons learned out of the execution process. What is the lesson that you have learned? Identify the areas of success, identify the areas of challenges, so that you can inform it to future projects and improve the appraisal process for the future projects. So these are all the various steps involved in the project appraisal process. Okay, I think you got it now. Next comes project control process. Project control process. So what is this project control process? This control process is considered to be very critical part of the project management. Control means nothing but monitoring and managing the progress. Monitoring and managing the progress of the project. Why it should be monitored and managed? To ensure that it stays on track always. That means, what is the meaning of staying on track? It is within the scope and it meets its objectives. To ensure that it is within the scope and it meets its objectives. That is called staying on track. So this control process focuses on comparing the actual performance with that of the planned performance and making adjustments wherever needed. That is what actual control process. Whatever being planned is to be carried out. So when it is carried out, you should actually compare it. Compare the actual performance with that of the planned performance, whether it is going in line with the planned performance or not. That is to be ensured. If at all it is not going in lines with the planned performance, then you have to make adjustments here and there as required again, so as to put it again in the track. So this is called project control process. Now, what are the steps involved in this control process, project control process? Let me list out the steps. Steps in project control process. I think it is visible on the screen now, the slide. Yes.
Yes,
Steps
sir.
in, yes. Let me explain this one. First of all, establishing a baseline. That means the first step under project control process is to establish a detailed project plan. What is project plan? What is to be done? When it is to be done? How it is to be done? Where it is to be done? By whom it is to be done? Rather, to put it in technical terms, it includes the scope of the project, budget, cost, and resources required, and then schedule, time schedule, as well as quality standards or specifications that should be very clearly prepared in detail. Okay, that is called establishing a baseline. Then monitoring and measuring performance. So under this stage, what happens? We have to collect data regularly on key performance indicators. What are the key performance indicators? The time schedule, the cost, the resource utilization, and the quality. These are the 4 key performance indicators of any project for that matter. I repeat, key performance indicators of a project may be the cost, the time, the resources, and the quality standards. So you have to collect data regularly on these KPIs. Then performance metrics, that is, measure the actual performance of the project using some metrics like scheduled performance, cost performance, quality control. These metrics can be used to ensure that the actual performance is being correlating with the planned performance. So that is called monitoring and measuring the performance. So then comes identifying variances. Once you compare the actual performance with that of the planned performance, then what happens? You may notice some deviations. The deviations, there is differences between actual performance and the planned performance. Say, for example, the planned performance says that this activity is to be completed within 4 days, but actual performance took 5 days to complete. So there is a deviation, there is a difference. So identify the differences, if any, in any area, whether in cost, whether in time, whether in resource utilization, or in quality standards, whatever it is. So what are the areas in which there is a discrepancy between actual performance and the planned performance? That is to be identified. It may be difference may be regarding time schedule, difference may be regarding cost. Once you identify the differences, the next part of this step is to analyze the root cause. So we have already had a planned performance. The planned performance is decided, that is baseline is decided on scientific basis only. If that is the case, why there is a difference now? The causes of difference are to be analyzed. We have to identify the causes, investigate them deeply, and then find out the reasons behind them. Say, for example, resource shortages may arise, or scope creep may arise. Scope creep means instead of doing something that is stated in the scope, you may do something else. Scope creep. Beyond the scope you can go. That is called scope creep. Or delays, unforeseen delays may take place in time schedule. So these are the discrepancies. Now you find out what is the reason for resource shortage, or what is the reason for external delay in time schedule. All these things should be analyzed, investigated very carefully, and you have to understand the reason behind them. Then, forecasting and predicting outcomes is the fourth step. Forecasting means based on current performance data, prediction of the future progress of the project is called forecasting. Predicting the future progress of the project based on the current data is called forecasting technique. Here, different techniques may be used. Once you forecasted everything, and once you identify the reasons for deviations, then the fifth step you have to take the corrective action. Under forecast, you can visualize that the project cannot be completed within the scheduled time or scheduled cost. Then in that case, you have to take corrective action. When variances are significant, then corrective actions must be taken to bring the project back on track. So these actions, these corrective actions may include adjusting the schedule. So deviation may arise either in time or in cost, mainly these two things. Okay. Then the scope also and quality, all the key performance indicators in all these areas, you may have deviation, differences or discrepancies between actual performance and planned performance. If it is in the case of time, reschedule the task, allocate additional resources to meet the deadlines. That is the corrective action. If it is in terms of resources, adjust the use of personnel or equipment or materials to address cost overruns or resource shortages. If it is more cost, then adjust your personnel or equipment or material accordingly to reduce the cost. Or if it is resource shortages, you reallocate the resources accordingly. See that everything is put in right way. Then reducing the scope. Now sometimes scaling back certain deliverables or reducing the complexity of the project to bring cost and schedule under control may be done. Scaling back certain deliverables, I said scaling back certain deliverables or reducing the complexity of the project are the corrective action for reducing scope. Then improvement of quality. Sometimes there may be discrepancy in quality standards. And in that case, implement process improvements to ensure quality standards are met without compromising the cost as well as schedule. So you have to improve the quality, of course, but you should not compromise the cost or time. So in such a way, it should be improved. Then comes sixth step, change control. So whenever a project progresses, definitely changes may arise. The changes may affect either the cost or time or the scope. Changes may affect the scope of the project or time schedule of the project or budget cost of the project. In that case, it is very important to manage these changes effectively. When changes are identified, they should be formally documented and analyzed for their impact. So whatever change you identify, immediately analyze the change. What sort of impact that it has on the project. Then changes must be approved by the relevant stakeholders before they are implemented. Suppose if you want to reallocate the resources or readjust the time schedule, then you have to get the approval from the stakeholders because originally they have approved your plan. If at all you want to change it, you should get the approval again from the relevant stakeholders before it is being implemented. So then only you can affect the change. Otherwise, you have no authority to affect the change. Then seventh step comes communication with stakeholders. The status report of the progress of the progress of the project should be updated regularly to the stakeholder. This is what I am insisting from the beginning itself. What is the progress of the project? What are the challenges that we are facing? What are the potential risk involved, and any corrective actions being taken? All these things should be clearly, transparently made known to the stakeholders at regular intervals. For this purpose, you can hold regular meetings also with the stakeholders and team members. Then project performance review is the eighth step. project performance review. So regularly analyze the project performance against the baseline, that is the planned performance, or against the key performance indicators, KPI. So regular analysis of the progress or performance of the project is essential. That will help you to identify the challenges or the success points. So you can learn lessons out of that, and that lessons can be used for further projects. Then final reporting and closing. Once the project is successfully completed, a final report that compares the actual performance against the planned performance can be prepared, and that will give an overall evaluation of the project. Then project closeout. The project control process concludes with the official closure of the project. Official closure of the project involves finalizing all documentation, verifying that all project deliverables have been met, and then releasing project resources. So these are all various steps involved in the closing of the project. Now let me move on to the next part of this. Control method. What are the various control methods are adopted under project management? There are mainly 3 control methods. Is it visible on the screen now? Is
Yes,
it
sir.
visible? Yes. 3 control methods. One is pre-action or prevention control. Number 2, concurrent control. Number 3, post-action control. Now let me discuss about this one by one. Pre-action or prevention control, first of all. So this is a type of control which is anticipating the problems and enforces required control so that deviations are prevented. I said that in the controlling and monitoring system of the process, a continuous monitoring system, that is controlling and monitoring mechanism, is to be ensured in a project. What is that? What is the meaning of it? Means the actual performance is to be always compared with the planned performance. That is called continuous monitoring of the project. Now here, under prevention control, what happens? You have to anticipate the problems in advance and enforce required control system so that deviations are prevented. It is not that after deviation arises taking corrective action. Instead, preventive method, you can forecast, you can anticipate the problems areas. What are the problem areas? 4 KPIs are there. One is cost, other one is time, third one is resources, and the last one is scope. So in these 4 KPIs, you can anticipate the problems and enforce the required controls in advance so that deviations may not be arising. They are prevented. So for example, in a project management software, a project manager implements a control that no purchase orders are generated without his approval of purchase request. So that is the control system, preventive control system. In case where small deviations are permissible, a system of setting a tolerance level must be in place. Okay, what is this control I am telling? Preventive control. So listen. Planned performance, say for example, is 100 units per day. Planned performance is 100 units per day. Actual performance. So you are sending the worker inside the factory, telling that you have to manufacture 100 units today. Okay, that is the planned performance. That is the standard set for him. Now, at the end of the day, when he comes out, you just measure his actual performance. So measuring actual performance and comparing it with the standard performance. Standard performance 100 units. The actual performance is only 94. Then compare it means there is a deviation, discrepancy. How much the discrepancy? 6 units or less than the planned performance. Now, whether this deviation is significant or insignificant, that is to be decided first. Whether it is significant or insignificant. So this level of significance will be, that is called level of tolerance level. Tolerance level, otherwise called, is already fixed by the management. Say for example, if the tolerance level is 5%, 5%, what is the meaning of it? 100 is the planned performance. 5% tolerance level means either it can be plus or minus 5%. That means it can be ranging from 95 to 105. 100 is the standard. 5% tolerance level means it can range from 95 to 105. 5% either way. So if a worker manufactures in between 95 to 105, that deviation cannot be taken seriously. If it is either below that or more than that, such deviation is considered to be significant deviation. Then we have to take a corrective action, identifying the causes of that. This is what this prevention control tolerance level says. Then comes second one, concurrent control. Concurrent control. I think it is visible on the screen now. Concurrent control. See, under this method, after the project activities have been commenced, this is being exercised. Concurrent, simultaneously. So when the project execution starts, simultaneously this control mechanism will function. So for example, these are called steering controls, otherwise known as steering controls. Conflicts arise between team members and are instantly solved in a special meeting. Is the example of concurrent control. When during the implementation stage, when there is some conflict between team members, immediately, instantly it is to be solved. That is called concurrent control. You should not allow it for further, so that things will be, say, collapsed. Therefore, without much delay, immediately, instantly, if the problem is solved, the discrepancy is set right, that is called concurrent control. Then comes post-action control, third one, post-action control. So this control system takes into account the end result of a project. Post-action, everything is over. Now finally end result is there. The end result is taken as a consideration. That means this is a futuristic control system. It is a futuristic control system. So for example, at the completion of the project, a record is made of what went right and what went wrong in the process of implementation of the project. That is called post-action control. You prepare a report stating what was wrong and what was right, so that it can be used for future projects. That is why it is called futuristic control, and it is being undertaken once the project is completed. So these are all different steps considered to be followed. Then comes the next concept, project audit. Project audit. Is it visible on the screen now, project audit?
Yes, sir.
Yes, let me continue then. Project audit. So this project audit in project management is an independent formal review, otherwise known as independent examination of a project's performance or the process and adherence to the standards prescribed. So audit means verification or review, scrutiny, that's all. So the project performance or the standards prescribed, whether it is being adhered to or not, is going to be verified. That is called project audit. It is a tool which is used to evaluate the health of a project at various stages of the life cycle. So we have 5 stages of life cycle. During every stage, the health of the project is going to be assessed. That is called project audit. So this is focusing on verifying whether the project is being managed according to the established practices or not, whether the project ensures that goals are being met or not, whether the project identifies lessons learned for future projects or not. This is what we are going to do. We have to verify whether this performance is being done in accordance with the prescribed, standards of the or scope of the project or not. That verification is known as project audit. Now, types of project audit. Types of project audit. Pre-project audit, otherwise known as project initiation audit. Now, this is being conducted before the commencement of the project or at the commencement of the project. It is to ensure that the project is correctly defined with a clear scope, clear objectives, and the deliverables. And then this audit reviews the project plan on the basis of resources required, budgeted cost, and timelines to assess whether the project is ready for execution or not. So the readiness of the project is being verified under this pre-project audit in terms of scope, objectives, deliverables, cost, resources, timeline, everything, whether everything is being ready to proceed. That is to be assessed under this. Then during the project also audit can be conducted. That is called during project audit. So conducting the audit during the execution process is called during project audit. That means we are going to evaluate ongoing performance of the project. That is why it is called during project audit. This type of audit focuses on monitoring the progress of the project against the planned performance, assessing the risk, ensuring that the project stays back on the track in terms of key performance indicators like scope, time, cost, quality, etc. So this will help you to identify the issues early or deviations. You can identify deviations early, allowing for corrective action immediately. Then comes the third one is post-project audit, otherwise called project closure audit. This is conducted after the project is completed. When the overall performance is being assessed, lessons learned are identified. What is went wrong and what is went correct. All these things are identified. Then whether intended goals have been met or not, whether the expectations of the stakeholders are satisfied or not. All these things are verified under this. This is called post-project audit. And then comes steps in a project audit. Steps in project audit. I think it is not there. Okay. Steps in project. And let me explain the steps in project audit. Planning the audit is the first step. So the audit schedule is to be created based on the objectives and scope of the project. So the audit scope and objectives are to be very clearly planned in advance. What is to be evaluated, when it is to be evaluated, how it is to be evaluated, everything is to be planned in advance. Then you have to collect the data regarding your evaluation, project documentation. You have to see the documents, progress reports, or project plan. This is going to be our financial records, our quality assurance reports. All these documents can be used to collect data, and you can also conduct interviews if it is possible. You can have a personal interview with the stakeholders so that you can elicit some information from them. Then based on that, you can evaluate the performance. Third step is to evaluate the performance in the terms of scope, cost, time, and quality. If you find any deviations, then assess the resource utilization efficiency also. Evaluate the risk management process also, whether the project responded to identify risk or not, whether corrective actions are being taken or not. Then finally, report the findings. Prepare the project audit report, giving all the details regarding your findings, namely strengths, that is what has went wrong, what has went correct, strength and weakness, deviations from the project plan, and then your recommendations to address the issues or improving the process should be given under this. So these are all the steps involved in the audit report. With that, let me conclude this unit number 4. Let me now move on quickly to unit number 5. Just a minute, please.
Sir, can we get the PPT of this?
Now I will send it by mail, sir. You just give your mail ID. Okay.
We'll share in the message box, sir.
I think otherwise it will be available with the distance education. Because they are recording everything now. Is it visible on the screen now? Unit number 5?
Yes, sir.
Yes? Okay. Let me proceed then. So under this unit, first of all, I am going to take up project managing versus leading of project. That is otherwise known as project management and project leadership. Project managing. What is the meaning of this project managing and leading of a project? So these two things, that is project managing and project leading, are just a minute, please, are very critical aspects of successful completion of a project. For successful completion, project managing and leading are the two important things. They involve roles and responsibilities of different people and skill sets required for various team members. All these things are included in this. So this project managing focuses on structure and processes. Project managing is focusing on structure and processes. This is primarily concerned with technical and administrative aspects of managing a project. Project managing is concerned with technical, organizational, and administrative aspects of managing a project. The role of a manager, project manager, is to ensure that the project progresses according to the plan, as per the budget cost, and as per the time schedule. This is to be ensured. That is called project managing. That is the role of project manager. This is more focused on the systems followed in the project management, the practices and processes adopted, and the control of resources to achieve the defined outcome. These are all the main issues that are being focused under project management. So what is the system? Skills required for project management. See, we need 3 types of skills: technical skills, organizational skill, and analytical skill. The technical skill is the ability in, otherwise known as expertise in project management tools, methodologies, etc. So whatever tools and methods, that is process and procedure that you are going to use, in that the team manager must have a expertise knowledge. That is called technical skill. The organizational skill, that is the ability to structure the track of the project, is called organizational skill. Analytical skill is the ability to monitor and control the progress of the project and adapt plans to keep the project on track. These are the three skills required for a project manager. Then what are the key responsibilities of project management? Key responsibilities of project management. Let me explain this now clearly. Planning and scheduling is one of the key responsibilities of project management. So you have to develop a detailed project plan with various timelines and milestones and tasks. This will involve using of different tools like Gantt chart, project management software, etc. So with the help of some tools like Gantt chart, you can develop a detailed project plan. That is the first responsibility. Second responsibility is resource management. Say all the resources are, say whether it is human resource or physical resource or financial resource, all these resources are scarce available resources. They are not available in abundance, scarce resources. Therefore, they are to be allocated and utilized efficiently. That means optimum utilization of available resources is to be ensured. Then comes budgeting is the next responsibility. Managing the financial aspects, namely cost estimation, controlling project expenses, come under budgeting process. Then comes risk management. So it is the responsibility of the project manager to identify the potential risk and develop the strategies to mitigate or avoid the risk. Then monitoring and controlling, regularly tracking the progress of the project, measuring the actual performance with that of the planned performance as usually is called monitoring and controlling. Then quality management is another responsibility, ensuring that deliverables meet the required standards and satisfy all the stakeholders' expectation is called quality management. Then comes stakeholder communication. That means keeping all stakeholders, that is clients, team members, sponsors, whatever it is, keeping all the stakeholders informed about the progress through the status reports or meetings and updates. This is called roles and responsibilities of a project manager. Then comes leading a project. Leading a project. Nothing but project leadership. It goes beyond just managing the project. That means it involves guiding, motivating, and inspiring the project team. So the project manager not only acts as a project manager, but also he is acting as the leader in the capacity of leader. It means he has to inspire, he has to guide, he has to motivate the members of the project, the entire project team as such. The role is to provide a clear-cut direction to the project members of the project team and make correct decisions that are aligning with the vision and mission and goals of the organization. So that is the main role of the project leader. What are the key responsibilities of the project leadership? Key responsibilities of the project leadership. Key responsibilities. Setting vision and direction is the first key responsibility of the project leadership. What is this setting vision and direction? Creating a clear vision for the project that is aligning with the efforts of the team members with the strategic goals of the organization. All the efforts of the team members should also align with the goals of the organization. In such a way, the vision is to be very clearly established. Then comes motivating and inspiring. The very purpose of the leader, very important quality of the leader is motivating and inspiring others. So that means he should encourage the team members, recognize their achievements, and enhance their morale. This is called motivating and inspiring role. Then decision making is another key responsibility of the project leader. Making decisions about the priorities, about the direction, and problem solving are the skills required for project leadership. Then team building is another responsibility. Building and maintaining a strong, cohesive, and collaborative team is the sole responsibility of the project leader. This involves trust, managing conflicts, and developing the skills of team members. You have to develop the confidence in the minds of the team members so that they will trust you and you can easily manage the conflicts. May not arise in that case, but all it arises, you can easily manage the conflicts. So that is called team building ability or role. Then comes communication. So you must possess very good communication skill, providing clear and inspiring communication about the vision and mission of the project and any other changes that may occur during the execution of the projects must also be communicated in a convincing way so that there will not be any, say, whenever you convince the employees or team members, there will not be resistance to change. So changes that occur during the execution must be communicated properly in such a way that it is convincing for the other people. Then comes next role is managing the change if any. So the leader of the team means he is leading the team through challenges and changes also. How he is leading through challenges and changes? He should create an environment in which people are adapting themselves to shift to the priorities and guide them throughout the project regarding the uncertainty about the project execution. So during the execution process, many uncertainties may arise, many potential risks may arise. During the periods of uncertainty and the risk, you should be in a position to guide the team members properly. So that is called managing change. That is another responsibility. Then comes skills required for a project leadership. Skills required for project leadership. Emotional intelligence, visionary thinking, conflict resolution, motivation. So these are the four important skill sets required for a successful or effective project leadership. The ability to understand, manage your own emotions, ability to see the big picture and communicate it effectively to other team members, ability to resolve disputes and encourage collaboration. Then the skill or ability to inspire and encourage the team members to perform in a better manner. These are all the skills required for them. Then project manager is another area to be discussed under this unit. Project manager. So the qualities of project manager as an important part in your syllabus. Let me now see who is a project manager and what are the qualities of the project manager. Another important area for examination point of view. A project manager plays a critical role in ensuring the successful completion of the project. What is the success? What is the meaning of successful completion of the project? The project should be completed on time, within the scope, and within the budgeted cost. This role is to be effectively fulfilled by project manager. For that, he must possess certain qualities. What are they? These qualities are listed down here. Let me show the screen. Qualities of project manager. I think it is visible on the screen now. Qualities, yes. Qualities of project manager. Number one, leadership skills. A project manager must be able to inspire and motivate the efforts of the team members, especially during the times of challenges. When there is an issue or a challenge and difficulty during that time, he should be in a position to inspire and motivate the efforts of other people. He should lead by an example. He should lead by an example. He should demonstrate the integrity. He should maintain a positive attitude to keep the team members focused and engaged on the completion of the project. That means he must be in a position to influence the behavior of the team members, stakeholders, and other key players so that to support the project vision and goals. That is called leadership skills. Then comes communication skills. Clear and effective communication is critical for a project manager. A project manager must be able to convey the ideas or instructions and updates to different stakeholders in a way that is understandable and actionable to other people. What is the meaning of effective communication? What is the meaning of communication? Can anybody say? Anyone say what is the meaning of communication?
Communicate effectively, sir.
Transformation of ideas from one person to other person. Transfer of ideas the person who is receiving the idea, the receiver of the communication, must understand it in the same sense and in the same meaning in which it is transmitted to him. That is called effective communication. Therefore, he must be able to convey the ideas and instructions in a way that it is understandable by them. That is called clear and communication skill. So that skill to be possessed by the manager, project manager. Then comes organization and time management is another quality of the project manager. A project manager should be highly organized to keep track of multiple tasks and various resources and also the milestones and also the schedules. So he must be organized always, highly organized to keep track of all these things. And also the time management is essential for a project manager to ensure deadlines are met clearly. Project manager must be skilled at prioritizing the task, delegating appropriately, and avoiding procrastination. He should also know how to balance competing demands and ensure the team remains on schedule without burning out. So, clear organization of the project to keep it on track and ensuring deadlines are met. These are the two important qualities called organization and time management. Then the fourth quality is problem solving and decision making skill. A successful manager, project manager, must be able to identify the problems quickly. He should be in a position to identify the problem earlier before they arise and find effective solutions for them, whether it is in the nature of resolving conflict, or whether it is in the nature of handling the risk, or whether it is in the nature of navigating the challenges, whatever may be that, he should be in a position to identify them quickly. And he must be in a position to encounter unexpected issues, unexpected delay, or unexpected changes. Similarly, decision making skill. A strong decision making skill is necessary for a project manager to make timely, effective choices. If you lose the chance, opportunity, it will not come again. Therefore, whenever a chance is there, effectively and timely it should be utilized. In such a way, you should take a decision. That skill you should possess. Then comes adaptability and flexibility. Adaptability and flexibility. Adaptable to change is very essential for successful completion of the project. So a project manager must be always willing to adjust plans wherever it is necessary. Therefore, because projects always face sometimes unforeseen changes, unforeseen challenges, either in scope or in time or in cost. Therefore, we must be always willing to adjust the plans wherever it is necessary, whenever it is necessary. Then comes the next quality, attention to detail. Attention to detail. So detail-oriented project managers can easily spot small issues before they become big problems. So that is the very important quality, detailed-oriented project manager. They can easily spot out small issues before they become big problems. They can monitor project progress meticulously, ensuring that nothing is overlooked, whether it is a task or whether it is a budget discrepancy, whatever may be the small or minor issue it is, that will not escape from the attention of such person. Such caliber you should possess. Attention to detail ensures that project deliverables are met as per the agreement, as per the agreed standards and qualities. So that is very important. Attention to detail. Minor details should also be focused, should also be taken care of very effectively. Then team building and collaboration is another quality. The project manager must be able to build and foster strong teams. He must be able to promote a collaborative atmosphere, a congenial environment where team members always feel at home, always they feel valued, they feel respected, and they feel encouraged to contribute. In such a way, you should create a confidence in the minds of team members. They should also encourage open communication. A project manager should encourage always open communication. Give respect to the opinions of the people and ensure that everyone is taken part in the decision making process and every resources are being effectively utilized. So this is what team building and collaboration quality. Then comes conflict resolution. Say, when many people are working together as a team in execution of a project, there may arise conflict in any place at any time for any member, between any members. There is every possibility for conflict arise. Therefore, a good project manager must always address the conflicts in a very constructive way and mediate them to resolve the disputes. So whenever conflict is there, he should have the capacity to address the conflict in a very constructive way and mediate between the parties to resolve the disputes amicably. Such a quality he should possess. That only will help to maintain morale among the members of the team, and that will, maintain the momentum of the project also. Then the next quality is risk management. A project manager needs to anticipate potential risk, whether it is financial or technical or operational or organizational, whatever it is. In all these areas, he must be able to identify the potential risk. And he must also develop strategies to mitigate or address them immediately. Proactive risk management may be resorted to. Proactive risk management, that is preventing the impact of problems and ensuring the project stays on track. That is called risk management. Then comes delegation skill. Delegation skill. Say a manager having the authority regarding the execution of the project. But actually, what happens? The project is being executed by the members of the team. So many people are there who are engaged in the execution process. Manager himself cannot do everything. So he must be able to assign the task appropriately to various team members. So in that case, when you assign the task, you should be in a position to delegate the authority also. Delegation of authority means transfer of authority from top level to the lower level. This delegation allows for a more efficient workflow. This delegation ensures that team members are empowered to take ownership of the task, and this delegation prevents burnout for the project managers. Delegation is not an easy task. There are so many impediments, obstacles for delegation. So, to delegate also, one should possess some skill. Delegating tasks effectively among the team members is a skill. That skill is to be possessed by the team manager. The negotiation skill, that is, whether negotiating with the stakeholders or team members, a project manager should be adept at negotiating agreements that align with the project goals. So whenever there is a discrepancy or a conflict, there is an issue, he must be in a position to negotiate and resolve the issues so that the project remains on track within the budget, within the time, within the scope, everything. So that negotiation skill he should possess. Then comes analytical thinking. That means you need to be analytical. You need to be analytical. What for? To assess the performance of the project, to interpret the data, and to identify the trends or issues. So if you want to interpret the data, you must possess the analytical thinking. Then only you can infer meaning out of it. And you must have the ability to identify the trend or issues that will take place in future. That is also based on your analytical thinking. You must be in a position to evaluate the KPIs to make data-driven decisions that keep the project on track. So analytical thinking is very important to infer meaning from the performance of the various KPIs. Then comes technical competence. So a project manager need not be an expert in every technical aspect of the project, but he must have a solid understanding of the technical requirements. He need not be expert in every aspect of the technical issues. Rather, he must have a solid understanding of the technical requirements and the tools related to the project. That only will help him to manage the resources effectively, and not only that, it will help him to communicate effectively with the team members. Therefore, technical competence is another point. Just a minute, excuse me for a minute, please. Then the 14th quality of a manager is customer focused approach. So always needs of the client is to be given preference. All your activities must be customer focused, focused on the client's need, and ensures that the expectations of the stakeholders are being fulfilled. Then comes 15th one, emotional intelligence. Say this high emotional intelligence of a project manager can help him to better understand and manage their own emotions and actions. So this quality, this attitude will enable effective leadership, communication, and effective conflict resolution. It also will help to maintain a positive and productive work environment in the workplace. So emotional intelligence must be very carefully managed. It will be helpful to manage your own emotion and the emotions of others also, so that conflicts can be easily resolved, communication, effective communication take place, and you can also effectively inspire others to or motivate others and increase their morale. And finally, the last quality is strategic thinking. Strategic thinking. See, strategic thinking ensures that the project aligns with the broader goals and long-term objectives of the organization. A project manager needs to keep an eye on the bigger picture of the organization, ensuring that the project contributes to the achievement of the organizational goal or achievement of the organization's vision and mission effectively. That is called strategic thinking. These are all the qualities required for a manager, effective project manager. Then comes the next part of discussion, managing project teams. Managing project teams. I think it is visible on the screen now. You know very well that a project team is composed of many individuals with varying skills and expertise, and with varying qualities and qualification. And a project manager's ability to effectively manage and motivate the team, therefore, is very essential for achieving the project goals. We have diversified workforce with different skills and expertise. So it is very difficult for a manager to blend them together so as to achieve the common goal. Or he must be in a position to subordinate the individual interest to common interest. That ability to effectively manage and motivate the team member is key for achieving the project goals. In that case, what are the various best practices or key strategies that a project manager can adopt in managing a project team effectively? Best practices in managing project team effectively. Let me go through this quickly, please. This is the last part of our discussion. With that, let us complete this. Clarity in roles and responsibilities is very essential. What is responsibility? What is the meaning of responsibility? Can anybody say what is the meaning of responsibility? What is expected of you is the responsibility. What is expected of you? Say you are a member of a team. What is expected of you by the organization or by the project manager is your responsibility. It is the obligation to be discharged. So here, what is the meaning of define clear responsibility? Responsibility means obligation. Obligation that is to be discharged. Clearly defining responsibility means what is expected of you should be made known to you. That is called clearly defining the responsibility. So what is expected of each member is to be made known to him clearly. That is called defining the roles and responsibilities. So the Rasi matrix, which we have discussed earlier in the, I think in first unit or second unit, responsible, accountable, that is responsibility matrix, about which we are discussing. During that time, I told about one tool called the RACI matrix. RACI, responsible, accountable, consulted, and informed. That matrix, the tool can be used for clearly defining these roles and responsibility of each member. So then comes establish effective communication. Effective communication means in such a way that it should be understood by the other members in the same sense and in the same meaning, so that there will not be any difference of opinion and everybody will know about the progress of the project very clearly. Then fostering a collaborative environment, that is creating a congenial atmosphere, environment, work environment that will definitely promote the creativity and problem solving skills. That will also encourage teamwork, where the team members can share their knowledge and expertise through brainstorming session or through cross-functional collaborations, etc. So collaborative environment, that means a feel at home environment is to be created to promote creativity and problem solving efforts. That will also encourage the culture of the team members, and the culture where team members are not just working on their own task but also helping each other also. That culture can be, each member will not concentrate not only on his work but also on the work of others also. There will be a cooperation and coordination among the employees. That is called collaborative environment. Then comes setting clear goals and expectations. A specific, measurable, achievable, relevant, and time bound goals are to be set. I repeat, specific, measurable, achievable, relevant, and time bound goals are to be achieved. That only it will guide the members' efforts of the team members. That is called setting clear goals. Then comes fifth one, provide necessary resources and support. Of course, when you expect an employee to perform well, it is your bounden duty to ensure that the required resources in the form of material, tools, training, etc., are supplied to him, provided to him appropriately. So it is the duty of the project manager to provide necessary resources and necessary support in the form of mentorship, guidance, solving obstacles if any. All these things should be ensured. Then empower and trust your teams. First, you should empower your team by giving them the autonomy to make decision on their own, but within the scope of the project. Then trust is another key in a project team. Micromanaging can lead to frustration and demotivation. So you should not interfere in each and every task, every small trivial things. Micromanaging will not work. Allow the team members to take initiative and make decisions on their own. That can be done only when you trust your subordinates. So empower your subordinates and trust your subordinates. Then build and maintain team morale. The morale is nothing but the willingness to work. Willingness to work is called morale. The team morale is to be boosted. It should be built and it should be maintained. So that can be done either formally or informally. This can be done through strengthening the relationship of the team members among themselves. Then resolve conflicts effectively. Conflicts are very natural to arise in any team, but it is the project manager's duty to address the conflicts promptly and constructively to avoid disruption of the work. So interpersonal issues and misunderstandings should be managed very properly through mediation and private discussions. You should encourage the culture of respect and empathy, where team members can understand each other in different perspectives and communicate openly among themselves. Therefore, there will be no conflict then. Then monitor team performance and provide feedback. So regular monitoring of the team performance with the comparing with the actual performance and the report of this monitor, that is feedback, constructive feedback or positive feedback about the progress of the project is to be provided to the top level management. Encourage professional development. That is, So you should support ongoing learning. That means encourage the team members to expand their skill set that will improve their performance and increase their engagement in the project through formal training or certification, skill building activities. Then comes adapt to changing condition. Whenever there is change, you should be in a position to adapt yourself. Flexible. You should be flexible enough to take the changes into the project without affecting the scope of the project or without affecting the cost of the project or time schedule of the project. Then encourage ownership and accountability. The team members must be encouraged to take ownership of their tasks and deliverables. Sense of accountability is to be instilled in their mind. When team members feel responsible for the outcome of their work, they tend to be more focused and committed. Therefore, encourage the team members to take ownership. They will be more accountable then. For this purpose, a team manager must hold team members accountable for their work, but do so with empathy and support. So here you should also consider them empathetically. That means stepping into the shoes of other people. That empathetical, outlook is very important to maintain a balance between accountability and understanding. So these are the various key practices that a manager should adopt for effectively managing the project team. So with that, I hope I have covered almost all the concepts of 5 units, which are very, very important and essential for examination point of view. And I thank you all for your patient hearing all through these days. And I hope my discussion with you or my association with you for these 3 or 4 days may give some benefit in the form of writing the examination. I wish you all to come out with flying colors in your examination. Thank you very much.
Thank you, sir. Thank you, sir.
Thank you.
Thank you, sir.
So I can send this study material if at all you provide your email ID or something else or some WhatsApp number or something. Otherwise, you can get it from the distance education week.